Happy Thursday. Welcome to the European Market Open. A minute to go until the start of cash equity trading. I'm Tom McKenzie in London. Here are your top stories. Will it be a hole in one? Investor attention, of course, turning to Jackson Hole, Wyoming for clues on the path of Fed policy. Taking out the toolbox, China pledges more support for the economy, supporting global stocks. Plus, power pinch. Global gas prices jump to near records. That as France's Macron travels to Algeria to shore up supplies. Let's take a look at futures then after that. Pledge by officials and policymakers in Beijing, a 19-point plan and around 146 billion US dollars, 1 trillion yuan of support, infrastructure spending. Worth noting, Goldman Sachs says it's not going to move the dial in terms of their growth projections for that economy. Futures pointing up by 0.6%. We had German GDP data coming out better than expected, still only marginally 0.1% for the most recent quarter versus the previous reading of 0%. The FTSE 100 currently up 0.1%. We continue, of course, to watch basic resources, oil and gas, following the jumps in gas prices that we've seen. The concerns about flows, not just from Russia, Nord Stream 1 closing down temporarily, at least at the end of the month, but also from Norway and the US as well. Currently, the FTSE 100 gaining 22 points, up 0.3% as we continue to wait for the other major indexes to open up. We're also, of course, going to continue to keep an eye on what's happening in the FX space. It's dollar softness today, and that's propelling some of that investor sentiment as well. Currently, the Spanish IBEX now 0.4% higher, and the CAC on up 0.7 as well. That focus, of course, on Jay Powell and what he has to say out of Wyoming on Friday. Let's switch it over, see how things are playing out, looking to the futures and across bonds, FX and commodities as well. US futures pointing to gains of 0.9% after ending up around 0.3% yesterday. European markets also closed out Wednesday just modestly higher. Currently, the single currency back on parity, having dropped below, of course, over the last few days, currently just at 1 euro dollar, currently gaining 0.4%. I've talked about that dollar weakness. That is clearly a factor. But, of course, the gas picture and those elevated prices is a key drag on euro longer term, is the view of many. US 10-year currently holding up above that 3% level. Not a lot of movement, just 1 basis point in terms of the benchmark. And Brent, 101, we've seen this grind up since the middle of the month, since about the 15th, 16th of August, by about 10% in terms of Brent prices. Above 101, up 0.3%. Let's get over now to Bloomberg MLive Managing Editor Mark Cudmore. Mark, you're looking at the recent rise in UK yields and how that really hasn't supported the pound.
Good morning, Tom. That's absolutely right. Here we are looking at the 2-year yields chart, and this is over the last 5 years, and you can see it's been pretty much in a kind of straight line. We're about flat today, I think maybe back a basis point or two. We did 22 basis points in a session yesterday, and really it's gone 90 basis points in just the last couple of weeks. A really tremendous move in 2-year yields. But of course, sterling is just getting sold off almost every day and is absolutely a weakness. So let's put this in a longer chart to get a little bit more context. And what we can see is if you look at this on 20-year chart, what we're doing is we're rising to the highest levels since before the great financial crisis. That was this big collapse here in late 2008 when things like Northern Rock were tumbling and Lehman Brothers, etc. And in fact, we're now back at we're below every level since pre-crisis, but we're higher than every level since the crisis. So we're really at this kind of binary tipping point that looks like we're going back into this old world. And you kind of think, okay, if we're going back into an old world where we have higher rates, higher yields, we're no longer going to have this extraordinary policy era post-GFC, surely that should be a good thing, that should be supportive. But this isn't supporting the pound at all. So why isn't this supporting the pound at all? Well, of course, it is inflation. And you can see this line at the bottom is the two-year yields minus headline inflation. And you can see this is absolutely down in the doldrums. We've completely collapsed. Holding sterling cash is just losing you money hand over fist in real terms, minus 8.4% based on the latest headline CPI print. And as we know, many people think the CPI situation is set to get much worse next year. So unless two-year yields go much, much higher, this is going to get even more negative, so it's even more drastic. This is why the sterling is trading so negatively. But there's one extra chart to show you here, which is in a world of rising yields, you need to be able to fund your current account deficit. And obviously, if you're only offering deeply negative real yields, your debt's not very attractive. And this is the UK current account deficit consensus forecast for this year. You can see it was normally hovering around 3.5% for much of the year. And recently, because of the energy crisis mainly, some of this is about Brexit and the structural deficit, but the real acceleration is about the energy crisis. It is now at minus 5.7%. 5.77% is the deficit of the current account to GDP. And that needs to be funded. But if you're only offering deeply negative real yields, you've got to be offering much, much cheaper, much more discounted assets. And that means a much, much weaker pound. Unfortunately, it does look like that the UK is at the risk of a proper debt spiral or else a very serious currency crisis.
Okay, Bloomberg MLive managing editor Mark Cudmore on that ugly picture for the pound, currently trading at 118. We're going to have SocGen's Kit Dukes on to talk FX as well, so we'll get his views on the pound later in the show. Thank you. Now, central banks that hike too aggressively to tame inflation risk inflating prices further. That is according to Nobel laureate economist Joseph Stiglitz.
Raising interest rates doesn't solve the supply side problem. It can even make it worse, because what we want to do right now is invest more in the supply side bottlenecks. But raising interest rates makes it more difficult to make those investments.
Okay, that, of course, as central bankers from around the world gather for the Fed's annual Jackson Hole Symposium. The spotlight is, of course, on Chair Jay Powell and just how hawkish his message will be. We are joined by two stellar individuals to walk through what is happening across these markets and, of course, look ahead to that speech. Laura Cooper, senior macro strategist, of course, for iShares, Amir at BlackRock, and Bloomberg's Christina Kino back in the London studio, I'm very pleased to say, covering FX rates and EM for us. Christina, let's start with you then. In terms of what we're seeing, in terms of that market optimism today, what explains it? Is it all about China? Because there are question marks and caveats around this additional fiscal support the policymakers have outlined.
Absolutely, Tom. But I think it really is the focus for markets this morning, because it's been a while since we've seen a little bit of good news out of China, right? And of course, the caveat that you mentioned is the fact that this is kind of a bit of a bad news is good news sort of situation, right? That the situation in China has deteriorated enough that the authorities felt it was warranted to deploy the stimulus. And in addition, also do some work on the currency front, because we are seeing simultaneously China pushing back against that strong dollar with a stronger yuan fix. And that is a more noticeable effort now from Chinese authorities than we've seen in the past few weeks.
Yeah, that surprised the markets, didn't it? That stronger fixing from officials at the PBOC earlier today. Laura, let's bring you in at this point then. Your assessments in terms of the markets as we look ahead to that key speech, the direction that you're seeing in equities.
Well, I think markets are certainly priced for a hawkish reaction from Fed Chair Powell when he speaks later today. And I think ultimately it does set up for quite a bit of bout of rates volatility, notably because I think the debate will all be around that 50 to 75 basis point hike in September. Will they give any clues as to the directionality around that? I think markets are hoping for that, but I think they may be disappointed. And the fact that equities have actually rallied on the back of the Fed potentially having a dovish pivot in the near term, that's not our view. So I would expect we are going to see some disappointment on equities as well.
So hawkishness being priced in by these markets. So if you get a signal from Jay Powell around 50, but a continuation of rate hikes around that challenge to bring inflation back, how do assets react to that kind of communication, do you think?
Well, that certainly would be quite a dovish reaction, but that is actually aligned with the comments that we have seen from Fed member Mary Daly, who says, look, the Fed funds rate is now within the neutral range, so from here on out, it's going to be more difficult. It's going to be more gradual of those rate hikes. It's going to be quite data dependent. So if he does take that stance, I would expect that we are going to see some of that front-end hawkish repricing come out ahead of that. But ultimately, I don't think that's going to be the case. If anything, probably leaning still more towards that 75 basis point move in September. Key, though, will be around whether he says, we need to continue to front load these hikes, which would suggest that 75 basis point is baked in. A clear disappointment, though, for the market could be, but they don't give any kind of signal. They continue to suggest that this is a meeting by meeting basis that's going to be data dependent. We still have a CPI print. We still have a payrolls print ahead. So markets may ultimately be left disappointed.
The importance of that data before that final decision, or at least next decision around September. Christine, when it comes to what we're seeing in terms of financial conditions, Laura touched on this. Conditions actually loosening back to kind of pre the first hike from the Fed. And you have the likes of Mike Wilson and the team at Morgan Stanley saying the markets aren't really factoring in quantitative tightening that's coming up in the months ahead. How should we be thinking about those dynamics when it comes to financial conditions?
Well, Tom, I think that's going to be kind of this back burner thing that's currently happening, because a lot of the focus is still on the rate hikes aspect of it, but it is a very, very important lever for monetary policy, and one that will have probably longer term consequences, especially for the direction of yields. I mean, remember that the Fed has been a major buyer of the Treasury market for a good part of the last decade. That is a major source of support for that market that would potentially start fading away, just as we're seeing these tightening via rate hikes coming through. And while, yes, there is now a little bit of a loosening in financial conditions, this might lull some people into a sense of complacency that, oh, everything is fine now and we're going back to this Goldilocks scenario. Then comes quantitative tightening, which people seem to have put to the back burner again, maybe forgotten about, coming through into the picture. And again, a reminder that this is a massive shift in Fed policy that will have a very significant impact in terms of raising yields from the very, very low levels that we've seen in the past.
Okay, don't underestimate the risks around quantitative tightening, certainly the view from Morgan Stanley. Laura, just before we get to break, we want to unpack the energy story more with you in the next few minutes, but let's start with inflation and your forecast from the team at you and BlackRock. Where do things stand? Because you've got break-evens now on the 2 years, now back above 1 year break-evens, suggesting from some maybe that these inflation expectations are becoming de-anchored.
Yeah, and I think it is the case, the fact that we have seen some of those market price measures start to creep higher is reason why we would expect the Fed to have this hawkish tone persisting. Now, going forward, we still see core inflation in the U.S. settling just above 5% this year, and then moderating somewhat to about that 3% range by the end of next year. But ultimately, we do expect that the central bankers are going to live with a degree of inflation. So we do think the Fed is likely going to hike to a terminal rate of around that 3.75 mark by Q1 of next year, and then pause, which will allow for that inflation to still remain quite elevated. It's quite a different story in Europe, though, reflective of what we're seeing in terms of the energy costs there. And I think even with the backup that we've seen in break-evens, we had ECB's Panetta come out earlier this week saying, look, we probably do need a significant recession or a significant slowdown in order to curtail this inflation. So I think that's really the key story to watch in Europe, more so than the U.S. right now.
Okay, so U.S. core to 5% by the end of this year, 3.75% on the rate by the first quarter of next year. Laura Cooper staying with us. We'll get more of her views, how to position around these markets. Senior macro strategist for iShares, Amir at BlackRock, of course. And thank you, as ever, for Bloomberg's Christine Aquino. Really, that is the headline of the day. She's back in the London studio. Christine, thank you very much indeed. Right, coming up, we take a look at the impact of the growing global energy crisis. And again, as I said, we'll get Laura's views on how to position around that. Stay with us. This is Bloomberg.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
No one covers the world like Bloomberg.
Does the sense will get to 7% in the coming months? Do you see that coming true?
There was something of a gray zone battle between Taiwan and China.
Where are the job cuts to come from?
We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrell. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the Open. We are 14 minutes into the European trading day. You're seeing gains of 0.6% across the benchmark. Every sector apart from two currently in the green, led by basic resources, construction materials and energy. You're seeing oil and Brent above 101. China coming out with some fiscal support in the shape of infrastructure spending around 145 billion US dollars. Let's get to some of the individual movers then. Some earnings, but also some regulatory announcements, or at least updates when it comes to a merger between Veolia and Suez for its the UK assets of Suez. And regulators here in the UK saying Veolia, the French company, must sell 3 businesses for this deal to be approved. They're saying it raises competition concerns. Alfen, this is a company that focuses on charging and energy storage, boosting its full-year revenue forecast, and it is a strong beat for the earnings. You can see the stock up more than 7% on the back of that. Different story, though, for Bachem, which is a biotech company. First-half profit shrinking on lower orders and taking a hit there. The stock down 3.5%. Let's get back to the gas story now and what is happening across the energy space. Natural gas prices have been soaring, of course, in European and Asian markets as the worst energy crisis in decades intensifies. How many times have we said that? We are now joined by Bloomberg's Anna Shurievskia, who's been watching all of this for us for months. Anna, what is driving the gas price right now? It's more than Russia, isn't it?
Well, obviously, Russia is one of the biggest factors. In particular, now we are seeing supplies via Nord Stream at 20% capacity, and that pipeline will be a focus next week when Russia will hold supplies via Nord Stream for 3 days for maintenance. So you never had a situation where everyone is watching that 3 days of maintenance. It shows how high the stakes are at the European gas market as we're approaching the winter heating season in a couple of months. In addition, you have Norwegian maintenance continuing into September, which will curb flows from the key supply to Europe. And in addition, LNG cargoes into Europe will see a competition with Asia as Asian buyers also start preparing for the winter and trying to fill their inventories there. And in addition, we have a prolonged outage at the Freeport LNG facility in Texas, now extending into November. That's well into the winter months, which may remove a dozen of cargoes from the market and impact European supply as we approach the winter.
Okay, Bloomberg's Anna Shurievskaya, of course, across what is happening in gas and the updates in terms of the pressures across that sector, not just from Russia, but also what's happening in terms of Norway, Nord Stream 1 as well, and challenges in terms of shipping LNG from the US. Thank you very much indeed. Let's bring back Laura Cooper, Senior Macro Strategist for iShares EMEA at BlackRock, still with us. And it seems on a day-by-day basis, Laura, we talk about new records being set around gas prices. How much of this is priced in? How difficult and challenging is it for the investment community to price this us into European equities?
Well, I think it's a case of which asset class you look at. Notably, if we look at European equities, we're still underweight on that asset class because we don't think that that is accurately pricing in the risks ahead. But if anything, what we've done is we've actually recently revised our growth outlook for Europe. We do anticipate that we are slipping into a recession in Q3. That's likely going to last for about 3 consecutive quarters, but there are still pockets of opportunities within markets. Notably, European credit tilted up the quality curve. We do think there are still attractive opportunities there given valuations.
But that's high-grade European credit.
Yes.
And the door is still open. The window's still open to get exposure.
The window is still open, albeit there are some technical headwinds through the back half of the year. But if we are looking at quite attractive coupon income, which we think compensates for some of those risks.
How much of a support do you think comes through? Are you changing your view at all on China on the back of the fiscal support we've started to see come through from officials?
So year to date, certainly, I think the stimulus that has come through has underwhelmed our expectations, perhaps unsurprisingly, because we are in this environment where a stop-start type of restarts on the back of the COVID challenges that we are seeing there. But ultimately, we haven't changed our outlook going forward. Right now, we're still quite cautious. We do think they're likely going to miss their growth targets this year, but likely make up for that next year. The key challenge, though, will be looking at the export picture, notably when we are in this environment where developed market economies are under greater pressure.
So but essentially further pressure on exports out of China as economies start to slow. Let's switch focus before we let you go to the UK. Mark Cudmore from our live team, of course, breaking it down in quite dramatic fashion in terms of what's happening. High yields, but weaker pound, and what it tells us. Maybe a debt crisis, maybe a currency crisis. Is that how you're looking at it? Which one of those is the greater risk at this point?
I mean, I certainly think the UK is challenged as a whole. I think the pound certainly has more downside pressure because the backup that we saw in front-end yields yesterday was quite remarkable. And this is just reflective of markets recalibrating their expectations for the Bank of England. The fact that we are seeing this energy crisis materialize and come in more stronger, we do think that that is ultimately going to kind of have a significant downturn in the UK economy. I think going forward, though, for the Bank of England, we don't think that they're going to actually be able to deliver, certainly on the exceptional degree of aggressive pricing priced in. If anything, we do think they could tighten to about that 2.5% range, well below that kind of 4.4% range currently priced in by the markets. Because ultimately, this is a country that is facing a significant terms of trade shock. They are energy importers. The more that those energy costs continue to increase, it's going to be quite challenging, as Mark alluded to get those capital inflows.
Okay, there's a huge gap between your forecast and the market forecast. As you say, 2.5% for the BOE, that's as far as they can get versus more than 4% from the markets. Laura Cooper, always excellent. Thank you very much indeed. In the studio for us, of course, senior macro strategist for iShares, Amir at BlackRock. We're going to get more on that China story then. Beijing announcing a $146 billion stimulus package to shore up its slowing economy. We will break down the details of that, what it tells us about officials and their thinking about the weakness, the fragility in this economy. Stay with us. This is Bloomberg.
Today, as the world watches inflation rise, employment rebound, and fiscal policies react, all roads lead to Jackson Hole for the Kansas City Fed's 2022 Economic Policy Symposium. Bloomberg's all-star team is live as policymakers and financial insiders discuss the economic issues and solutions that keep the world's money moving. Coverage starts today on Bloomberg Television and Radio.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
Welcome back to the Open. 23 minutes into the European trading day. Gains of 0.7%. Part of that is down to China stealing at least some of the limelight before Jackson Hole and Jay Powell. China stepping up with more stimulus to stabilize its slowing economy, the majority of which is largely focused on infrastructure spending. The State Council is earmarking $146 billion in policy and financial tools. For more, we are joined by Enda Curran, our Chief Asia Economics Correspondent in Hong Kong. Enda, talk to us about the significance. You were talking in the break about how this could be additional, this could be new money from China, but there's also a sense of reticence.
Yeah, so it's a big headline, Tom. You're talking basically $150 billion. It does speak to more urgency. This money's going to go in two ways. The big state policy banks are going to be allowed to invest in infrastructure on one side, on big projects, and of course local governments can go off and spend money on the extra side. Now the new money seems to be going into the local government side of it. They already, of course, are spending within their quota. It looks like they're topping up their quota, so they're getting some extra cash there. But the point is that, you know, already people are saying this is not going to be a game changer. 150 billion US might be big in the Western world, but it's not in the context of China's economy and the size of the issues they face with the drag from real estate and with the drag from COVID-0. Interestingly, the State Council actually are making the point that they're still being conservative when it comes to stimulus. They don't want to go overboard. The kind of language that you once might have heard coming from, is say, the likes of the Bundesbank in Germany back before the pandemic. They're sticking with this fairly rigid line, but there's a lot of questions about over how long China can hold on to this line, because even Goldman Sachs were saying this morning this spending in and of itself won't be enough to change their view for only 3% growth this year. So plenty of question marks, Tom, about where the support for the economy will come from.
Yeah, so Goldman Sachs sticking to that 3% view despite that increased and step up in terms of fiscal support. What needs to happen then, and what would change the calculus for Goldman and others around the projections on China's economy briefly?
Yeah, okay, so first of all, we need to see where this money will be spent, what kind of infrastructure. I mean, there's a lot of new energy projects they could do that does generate jobs and activity. So that's, to give them their credit, we have to see where they're going to spend the money. But ultimately, Tom, we need to see, are there going to be big pivots on some of the big policy questions around real estate and on COVID. Those are the two issues that will dictate where China's economy goes from here.
Okay, so watching real estate and watching exactly where this money goes. Enda Curran, always excellent. Thank you. Our Chief Asia Economics Correspondent out of Hong Kong, breaking down the fiscal stimulus and the support that we've had through officials from Beijing. Around 146 billion US dollars, about $1 trillion yuan in terms of infrastructure spending. But of course, Enda highlighting the point that COVID-0, of course, those restrictions continue to constrain that economy. We have a drought as well, particularly in Sichuan, and that is impacting the industrial base. Let's check in on these markets before we get to break. You're seeing gains holding up still of around 0.7% across the benchmark. Part of that is down to a bit of optimism coming through from China. The DAX up 0.9%. Over in France, gains of 46 points as Macron heads to Algeria to try and secure additional supplies of gas. How successful he will be, we'll continue to monitor. Coming up, SocGen's FX strategist Kit Duke. Stay with us. This is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, you know, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed. Welcome back to the Open. We are 30 minutes into the European trading day, and here are your top stories. Will it be a hole-in-one? Investor attention turns to Jackson Hole, Wyoming, for clues on the path of Fed policy. Taking out the toolbox, China pledges more support for the economy, supporting global stocks, at least for now. Plus, power pinch. Global gas prices jump to near records as France's Macron travels to Algeria to shore up supplies. So, yes, we did get that pledge, a 19-point plan from the State Council over in Beijing, plus $146 billion or thereabouts in terms of fiscal spending, particularly focused on infrastructure. As Ender Karen is saying, it's going to come down to where that money goes. Goldman Sachs, though, saying it doesn't change their views on that economy. 3% growth is what they're looking at for the year. In terms of the markets, though, it did give something of a boost to equity markets. The European Stock 600 currently up 0.6, almost 0.7%. They closed yesterday in the green modestly, added US stocks, the S&P ending up around 0.3%. Over in Germany, the DAX up 100 points, the FTSE 100 gaining 0.6, close to 0.7% as well. Worth pointing out the basic resources, energy amongst the leading sectors, and we'll look at those now. Energy up 1.4%, construction material, basic resources 1.29%. Oil, worth pointing out, Brent is back in terms of above $100 about $101 a barrel. It is up since about the middle of the month by about 10%. We continue, of course, to monitor what's happening in gas prices back to fresh records, the challenges that poses as flows reduce, not just from Russia, but also Norway, and the challenges getting LNG from the US. Let's get back, of course, to the macro picture then when it comes to monetary policy. And the financial world is, of course, again, focused on Jackson Hole, where the Fed is holding its annual symposium in some beautiful and rustic surroundings, of course, Grand Teton. How did global leaders start going there in the first place? Bloomberg's Mike McKee sent this from Wyoming.
It's gorgeous, but not luxurious. Jackson Lake Lodge is where economists and central bankers gather every year, not for the accommodations, but the conversations. Housed not in fancy hotels, but rustic cabins, they come for 2.5 days of eco-nerd talk about math-dense academic papers. They meet in this functional conference room, not quite the same as the electronically wired, mahogany-paneled Fed conference room back in Washington. For Global Wall Street, it's not about the conversations or the accommodations, but the implications. The papers don't matter much to investors, but the policymakers' comments on TV and in print do, particularly the Friday keynote by the Fed chairman. Talk of inflation, unemployment, recession, and what it all means for interest rates and profits. Now, we're here because of Paul Volcker. Back in 1981, the Kansas City Fed wanted a big name for their new conference. They came to Jackson Hole because the trout fishing is great, and Volcker loved to fish. The rest is history. The irony is this year, the financial world is wondering whether current Fed Chair Jay Powell will be Volcker-like in committing the central bank to fighting inflation above all else, even if it results in recession. If he isn't, stock markets might fall. And out here they know you don't feed the bears. Michael McKee, Bloomberg, Jackson Hole, Wyoming.
All right, the one and only Michael McKee sporting quite the Stetson there. Now, we are joined by Kit Jukes, who is also familiar with the Stetson and ranching, apparently. Head of FX strategy at SocGen. Kit, I'd love to get your views and get some more colour on what ranching involves. But we'll start with the US. We'll start with the US dollar as we lead up to this speech from Jay Powell. It's come off a little bit. Is this how much should we read into the price action today around the greenback?
It still trades risk sentiment in a pretty big way on a day-to-day basis. So, you know, there was a story on Bloomberg yesterday, day before yesterday, maybe, someone saying that the long dollar trade is the easiest trade in the market, and my hair stands on end, what's left of it, when I hear people saying that. Nothing is supposed to be easy in foreign exchange. So it's quite crowded. A rally in equity markets, a bit of a boost from the Chinese, and a bit of a sell-off from the dollar. Nothing else.
Still the best game in town?
Yeah, I mean, it's still going to be. I think there's more a question in my mind now. I think it's going to stay strong for a long time, more than necessarily go another 10%, if you see what I mean. In the sense of, you know, the terms of trade story, the price we're paying for gas, the fact that the US has turned into an energy exporter or the biggest energy producer in the world is a game changer for what this crisis means for the dollar. But I don't think there's anybody left out there who hasn't spotted how bad the energy crisis is in Europe, how much the Japanese are paying for energy.
So euro dollar, that cross is now more driven by energy than whatever happens with the ECB or Fed.
I think so, you know, in this cycle, because the terms of trade move is so, the relative one particularly, is, you know, it's vastly bigger than anything that's happened since the euro was started in terms of terms of trade. So that's not to say that terms of trade will always matter. It's just that this is enormous and much bigger than any shift in, you know, is Fed funds peak going to be 3.5 or 4? Is it going to be in May next year or be pushed out? Are they going to? So, you know, those are. I mean, that's small beer compared to how the big question of how long will this last?
And so, on that point, what is needed to shore up the euro?
A sense that we know when this ends. So if I was completely convinced, if someone can convince me, you know, that we're going to get our gas supplies to a good enough level, and we're going to find alternative sources, and the gas price that we're going to pay as consumers is going to be, you know, lower by Christmas, and then next year this will all be gradually a bad memory that we can forget, then I would be thinking, all right, how soon can I start buying the euro and the pound on that prospect?
Still a long way from that.
We're light years away from that day. We just don't know. What it feels like today is, you know, that this is going to get stuck here. This war's going to drag on. Nothing much is going to change. We're still going to be scrapping around. The price of spot gas is going to stay very high, you know, for the rest of this year, and then what? So, you know, and we sit and discuss, you know, how deep the recession will be, and so on, which is kind of slightly marginal, but we have very little clarity.
You've been very straightforward in your views on the pound the last time we spoke, and our MLive team pointing out today that even versus the yen, one of the most unloved currencies this year, the pound is faring badly, despite what we've seen in terms of the run up in yields. Is this a potential currency crisis with sterling?
No, it's just a potentially, well, it could become one. You know, balance of payments in terms of trade don't tend to lead to crises per se. But what we are today, and hopefully this will end quite soon, we're in a massive political vacuum at a time of huge economic uncertainty because of the way we price energy in particular. So away from anything else that's going on, with a central bank that is facing a bigger inflation problem and a worse inflation growth trade-off than any other major economy. So they're going to have to hit inflation hard, and we're going to have to suffer. And there's very little debate about whether they should raise rates aggressively and keep on going. There's a few, you know, Danny Blanchflower and people like that who will say, if you know there's going to be a recession, why keep on hitting this dying animal? But without all that, you know, it's likely to get worse before it gets better.
Do we get to parity?
No, I don't think so. I don't think we'll get through 110 against the dollar. I'm pretty sure
we do get through 110.
I doubt we'll get through 110. Okay. I'm pretty sure we'll get through 115 at some point.
Okay, 115, maybe 110 is the level.
I think you have to have something new and different to get. that low.
Okay. What are your favorite crosses then? Where are you hiding out? Is it Swissy? Is it commodity FX? What do you?
I think we're morphing back slowly in markets towards the commodity producers that are a long way away. I think once we get through summer, currencies which have had fantastic terms of trade. An Australian terms of trade story is as good as ours is bad, almost, in terms of where they are. So I think the Australian dollar, New Zealand dollar should start doing better over time, particularly if China comes in with more stimulus. You can already see that some of the currencies like the Mexican peso actually outperforming the dollar still at the moment because they're going to be beneficiaries from what's going on. I think you have to stay pretty far away from Europe. And if we keep oil prices coming in the right direction, there is a moment out there where the yen starts looking like a pretty attractive currency. And you know, I think it's going to mess around.
What exactly would be the catalyst to want to get exposure to the yen then?
Yields peaking.
Okay.
Once you're confident that you've seen the high in 10-year notes for sure for this move, then I think dollar yen looks to me to be the first place you could get a fall in the dollar.
Okay. Always excellent. Kit Dukes, of course, just updating you on where we stand in terms of FX right now. 118 is what you're looking at on a pound. 118 gains of 0.4%. The Bloomberg dollar index is lower by 0.3%. Euro dollar effectively at parity, up 0.4%, again down to dollar weakness. Kit Dukes, head of FX strategy at SocGen. The call there maybe to get some exposure to those commodity-linked currencies at some point. Aussie dollar and the trade balance story there in favour for that currency. Coming up, calls in the UK for more emergency government support as the energy crisis grows. That is next. This is Bloomberg.
of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan's society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
Countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Welcome back to the Open. 42 minutes into the European trading day. Gains of 0.7% across European equities. Here in the UK, the FTSE 100 currently up around 56 points at 7,527. Now, pressure is growing on the UK government to draw up emergency measures to protect households and businesses from high energy costs moving into winter. Ever higher energy costs. Household bills have been soaring and are set to rise further with tomorrow's announcement by the energy regulator of a new price cap. Let's bring in Bloomberg's Lizzie Burden then here in the London studio. Lizzie, what are we expecting from Ofgem tomorrow?
Well, Ofgem's going to tell us how much households' energy bills will rise in the fourth quarter, and one estimate says that it'll be 80% up, and that would take the average bill to about £3,500, so more than 3 times the pre-pandemic level. And you've had one of the EDF energy bosses warning that more than half of UK households are going to be in fuel poverty by January because bills are expected to continue rising, and this is why cities forecasting that more than 18% inflation in Q1 next year. So this is top of the in tray for whoever is the next Prime Minister, both in terms of how to support households through the crisis, how to perhaps change the system, but also there's the question of how to deal with businesses, because they're not covered by this price cap. They've not had any help so far, and overnight you've had industry bosses warning that perfectly viable companies could collapse because they're not going to be able to deal with the wholesale gas prices that they're exposed to.
So that's the business front. As you say, just it's remarkable. More than 50% of households in fuel poverty next year if nothing's done. How does the UK response compare to the response we've seen on the continent then?
Well, the consumer price cap is pretty similar to what happens in France, but what's different about France is that EDF, the main supplier, is almost pretty much nationalised, and therefore the government there has much more control over prices than in the UK. Of course, former Prime Minister Gordon Brown has suggested that the UK government could do something similar, nationalise energy companies that fall on their knees. But the other point about the difference between the UK and the rest of Europe is how people use their energy. So in the UK, gas supplies homes predominantly. It's the biggest category after transport. So it's not just how we regulate it, how we charge for it, it's also the way we use our energy, despite the rise of renewables in the UK.
I'm assuming we're not hearing much about nationalisation plans from either of the two leading contenders for the next Prime Minister, Truss or Sunak. What do we expect from the next Prime Minister in terms of tackling this acute crisis?
Yeah, not when they're trying to do their very best impressions of Margaret Thatcher. Well, we've had the opposition leader, Keir Starmer, suggesting that the windfall tax on energy companies is continued in order that energy bills can be frozen, so it would cost about £29 billion. The question is, how sustainable is that when this could be the new normal for energy prices? It's unclear how the two candidates would respond. Rishi Sunak has said that he would provide targeted support for households. Liz Truss has said that she's against handouts, but there are hints that she'll be doing an emergency budget or something under another name, but something similar, as soon as she comes into office. But there are suggestions on the table that were unthinkable until recently, and there's a brilliant article about this on the Terminal. There's the nationalisation proposal from Gordon Brown, but there's also this idea that you could have an OPEC for gas to try and manipulate the gas markets. And of course, we already heard that the business department, in the worst case scenario, has been looking at blackouts, targeted blackouts, to try to dampen demand.
Okay, Lizzie Burden, thank you on the challenges facing the UK when it comes to this energy crisis. Let's get now and continue, of course, on this topic and bring in the French component, which was mentioned there by Lizzie. As the energy crisis caused bites in the UK, across the Channel in France, President Emmanuel Macron is also looking for relief ahead of a challenging winter. Later today, he's going to arrive in Algeria, the former French colony and one of the world's largest gas producers. For more on this, let's bring in Bloomberg's Caroline Conat, who is in Paris for us. Caroline, what are the reasons then behind this trip by Macron? What is he hoping to achieve?
Officially, Tom, gas is not at the heart of the agenda. Officially, this trip is about rekindling the relationship with Algeria that's been damaged recently by a lot of misunderstandings. You had tensions over visas. Last year, Algeria recalled their ambassador in France. And of course, this year is the 60th anniversary of Algeria's independence from France after more than a century of colonization. But of course, both countries know that they have mutual interest ahead of this challenging winter. France needs more oil and gas from Algeria, and Algeria needs more wheat and cereals from France. In fact, Algeria exports gas to Europe through 3 pipelines. 2 go to Spain, 1 goes to Italy, but also LNG tankers. And France, in the south of France, in Marseille, you have big LNG facilities. So technically, France could welcome more gas through the Italian pipeline, but also through LNG tankers. Currently, Algeria is the first source of LNG to France, and about 10% of the gas imported to France comes from Algeria. So the NGCO and the French finance minister will also be part of the trip.
What is the ability then, Caroline, for the Algerians to step up supplies and support France and get more energy over to that country ahead of the winter?
Clearly, Algeria's profile has risen since the war in Ukraine. It is the 3rd biggest gas provider to Europe, but of course, that proportion is set to rise given Europe is trying to cut its reliance on Russian gas. But technically, the problem for Emmanuel Macron and for other countries in Europe is that Italy already went in. Last month, Mario Draghi, the Italian Prime Minister, already went to Algeria and signed a $4 billion deal with Sonatrach, the Algerian state-owned company, in order to increase the supplies from Algeria to Italy through the Transmed pipeline. So already Italy has taken a lot of the extra capacity that Algeria can provide. Then you have an issue with one of the pipelines going to Spain through Morocco, because there are diplomatic tensions between Algeria, Spain, and Morocco over a territory in Western Sahara. So that pipeline going through Morocco is currently not operating. And of course, finally, you have some LNG capacity. That's about half of the exports of Algerian gas are through LNG tankers. But the Sonatrach head has already warned that only about 50 to 60% capacity is possible currently at the liquefaction plants in Algeria. So technically, Algeria can be a small part of the solution, but is not going to solve Europeans' energy crisis.
Oh, okay. Well, we will be watching, of course, and you will be watching what happens during that visit. Of course, Emmanuel Macron heading to Algeria later today, and we'll see what comes out of that. Caroline Connard in Paris giving a preview. Thank you. Coming up, chipmaker NVIDIA issues a warning about its third quarter revenue in another sign of weakness in the semiconductor industry. That is next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
can ESA help humanity take its next giant leap?
Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrell. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg.
Welcome back to the Open. Happy Thursday, 53 minutes into your trading day, 0.7%, so some pretty decent gains across these European markets. A bit of stimulus coming through from China. Looking ahead, of course, Jay Powell and the futures stateside pointed to gains of around 1%. Let's take a look now at some of the things to watch out for today. At 12:30 p.m. UK time, the ECB will publish the account of its July policy meeting. The challenges, of course, for the Central Bank of Europe. Then at 1:30 p.m, we will get some US data, including GDP and initial jobless claims, followed at 2:30 p.m. by Tesla shares beginning trading on a split-adjusted basis, following shareholder approval of a 3-for-1 stock split earlier this month. So the focus on Tesla later. Also, the Kansas City Fed hosts its annual economic policy symposium in Jackson Hole. We may have mentioned that. That's in Wyoming. Jay Powell, of course, the importance of that speech on Friday. Right, let's get back to the corporate space. Chipmaker NVIDIA has given a disappointing forecast for its third quarter revenue. The company says revenue will be about $5.9 billion, well below an average analyst estimate of $6.9 billion. It comes after a recent warning from NVIDIA that its sales were slipping. For more on this, let's talk to Bloomberg's Debbie Wu in Taipei. Debbie, what is NVIDIA's latest forecast? What does it say about global chip demand? Does it mean we're going to be getting our electric vehicles delivered more quickly?
That's not necessarily the case, but I will talk about NVIDIA's forecast first. So it has warned, earlier this month that its sales in the current quarter will be weaker than expected. And indeed, what it said yesterday was that its sales for this quarter will be about $1 billion less than what analysts are looking for. And it is saying this is because there's the demand for gaming computers is weakening, and then market condition is challenging. And this matches from what we understand from Taiwanese contract PC makers are saying that they expect PC shipments for this year will be about 15 to 20% less than last year. And as to, does that mean that we will be able to see that car makers and others to get the chips more quickly? Not necessarily, because even NVIDIA is saying that it is still struggling to get some sort of support chips for its product, so it cannot ship as much as it wants. And then chip equipment supplier Applied Materials also said earlier this month that it cannot get enough chips for the all equipment it wants to make, so it can still not satisfy all the demand yet. So this indicates that there is still a shortage of certain niche chips that companies are looking for, and that also means that chip makers are still likely to spend quite significant amount of money to continue expand capacity into next year.
Okay, still spending to expand the capacity. Debbie Wu, always fantastic across semiconductors out of Taipei for us. Thank you. We are coming, of course, to the close of the European Market Open show. Surveillance early edition is up next. Gains across the European equities, 0.7%. Future stateside pointing to gains of 1%. This is Bloomberg.
cryptocurrencies have been very popular. And if a client came to you and said, look, I'd like some cryptocurrencies in my portfolio, what would you say?
Oh, we've actually been really deep into crypto, deep into learning about blockchain, and all of the new businesses. You know, I would characterize us as crypto learners. You know, we have made a series of toehold investments on behalf of our clients, both in some of the currency baskets as well as with some venture firms that are investing primarily in the crypto area. I think it has the potential to be completely game-changing, but it is still such the Wild West, and it's so uncertain. But it has the potential to completely upend everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
We got negative payroll data in the next couple months, and that's possible because the household data is already negative. That would be maybe something where they would pause.
What do they really want to see from inflation? Because if you're waiting for inflation to get to 2%, this is going to, funds are going to be meaningfully higher than anyone appreciates.
Raising interest rates doesn't solve the supply side problem. It can even make it worse.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London, snapping in for Francine. Here's what's coming up on today's programme. Will it be a hole-in-one? Investor attention turns to Jackson Hole, Wyoming, for clues on the path of Fed policy. Taking out the toolbox, China pledges more support for the economy, supporting global stocks. Plus, power pinch. Global gas prices jump to near records as France's Macron travels to Algeria to shore up supplies. Let's check in then on these markets. The top line, of course, coming through from China in terms of a 19-point plan from the State Council there in Beijing to support that beleaguered economy, including spending of around 45 billion US dollars on infrastructure spending, underscoring some of the optimism. It is risk on. Yields are off. Equities are up. How long is that going to be sustained for, though, as we look ahead to the importance of that speech from Jay Powell? Gains of 1% in terms of the futures stateside. In terms of euro dollar, you're back above 1, still essentially at parity after being below that for a number of days. Gains of 0.3%. The dollar is weaker. The 10-year as well. Yields coming off about 2 basis points the last time I checked. Here in the UK, FTSE 100 up 0.8%. Similar picture in Germany on the DAX. The CAC in France gaining 0.8%. President Macron heading to Algeria to see if the Algerians can do anything in terms of increasing gas supplies, not just to France, but the rest of Europe as well. FTSE Mid currently gaining 0.6%. We'll get more on the details of the Italian political risk as well in the days ahead. We've got some breaking data when it comes to at least a survey, the IFO survey, the German August IFO Business Confidence Index coming in at 88.5, so actually stronger than the estimates of 86.8. So confidence coming in slightly stronger according to this IFO survey. The August IFO Current Assessment Index, 97.5. That was also coming in above the estimates of 96. The Expectations Index coming in at 80.3, also coming in above the estimates of 79. Of course, the broader context is that high energy prices, record gas prices are really proving quite a constraint in terms of the industrial complex of Germany as well as households, of course. I'm going to break down those numbers and get reaction, get analysis later this hour with Timo Vollmerhauser, who's IFO's head of economic forecasting. Let's get back to what's happening then on the central bank front. And of course, central banks are hiking too aggressively. This is the view, at least, to tame inflation. And that risks inflating prices further. That is according to Nobel laureate economist Joseph Stiglitz.
Raising interest rates doesn't solve the supply side problem. It can even make it worse, because what we want to do right now is invest more in the supply side bottlenecks. But raising interest rates makes it more difficult to make those investments.
Okay, Joseph Stiglitz, of course, there, the Nobel laureate. Central bankers from around the world are gathering for the Fed's annual Jackson Hole Symposium. The spotlight, of course, is on Chair Jay Powell. Just how hawkish that message will be. We are joined now by Aaron Captain, Global Head of Economic Research at UBS. Aaron, you say in your notes to us that Jackson Hole is Jay Powell's chance to lead. What do you see him doing to retake the initiative?
Yeah, I don't think he necessarily wants to guide, pre-commit to the September meeting, because that's still 3 to 4 weeks after the speech, and there's lots of data to come. But my guess is he's going to defend the Fed's record on inflation. They've obviously been heavily criticized. But by the same token, he also doesn't want to ease financial conditions. So I think what he'll do, rather than focus on the September meeting, is focus on the cumulative cycle, where the Fed median is still a little bit above the market pricing. So he'll clearly signal, I think, that they're not done yet. So it'll be hawkish, but it won't be so hawkish as to pre-signal, I think, 75.
Okay, so in terms of the signaling, that debate, of course, continuing around 50, 75. You talked about financial conditions. We have a chart that illustrates what's been happening. We're showing it now. Financial conditionings actually easing back, looser than they were before the first hike from the Fed. And what do you make of that change?
Well, so there's a few things going on. I don't know what exactly you have in your indicator, but obviously we've had a bit of a bounce in equity, and you know, that's an easing. We've also, of course, had the market. Well, the market's been all over the place, but the market has priced out some of the tightening that we had in earlier, and partly that's just on growth fear, right? So we've seen a material weakening in growth momentum in the U.S. and elsewhere, and so the assumption is that that will ultimately make the central banks more cautious. I think that's right. If you look at the Fed minutes that came out last week, there's increasing concern, I think, about the cumulative impact of the tightening cycle, and they're starting to see it in the data. So I think it's, you know, what we're sort of having a bit of a course correction now, that we're moving into a new phase of tightening where while they're still hawkish, they're also becoming more cautious. And so we're going to start to see a step down now in the next couple of months in the pace of that tightening.
And Aaron, if we get communication from Jay Powell along those lines around a little bit more caution, this step change in terms of the tightening regime, how do you expect markets to react to that?
Well, the market is more or less pricing that, right? So the you know, the peak is roughly in March. So the, you know, in the Fed's own forecast, obviously it's going to get updated in September. You know, they go to 375.4. The market as a peak is roughly there, slightly below it. And then, but the market has the cuts coming a little bit earlier, right? So in the Fed's forecast, they have the cuts coming in 2024. The market has sort of a first full cut price by roughly the third quarter of 23. Now, of course, they're different because the Fed is a model forecast. The market is a probability weighted forecast, quote unquote. But so they're roughly really aligned. I don't think at this stage there's too much light between the two.
Okay, Aaron Captain, Global Head of Economic Research at UBS, staying with us, getting your views, Aaron's views on Europe after the break. Coming up, we take a look at the impact of the growing global energy crisis. That is next, the details. This is Bloomberg.
the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
The top names at the Fed are on Bloomberg.
I have a baseline case going into September that is 50 basis points. That's where I've been since the last meeting. But I have an open mind about whether 75 is going to be necessary. 50, 75 doesn't just depend on a data point, even an important one like the CPI. I like to say that we're data dependent, we're not data point dependent.
Nobody covers the Fed like Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie here in London. Let's turn our attention now to energy. Natural gas prices have been soaring in European and Asian markets as the worst energy crisis in decades intensifies. We are joined now by Bloomberg's Anna Shuraevskaya, who's been following all of this for us. Anna, what is driving the gas price reaction right now? A headline crossing the terminal just in the last few seconds. France's year-ahead power prices rising more than 8% to a record 850 euros per megawatt hour.
Indeed, European gas and power prices are renewing records almost on a daily basis right now. Europe is in the middle of an energy crunch, particularly driven by lower gas supplies from Russia. Especially next week, the market will be watching a 3-day shutdown on the Nord Stream pipeline. And also, we have nuclear output reductions in France. So the energy crisis is on the agenda. In gas prices as well, we have LNG prices rising in Asia, which is also driving European prices high because the two regions have to compete for available cargoes, and Asian buyers are starting to buy the fuel for their winter stockpiling as well. And on top of that, we have the Freeport LNG plant in Texas, extending its maintenance into November. That will further squeeze the markets, and we are going to approach a very tight situation as we approach the winter heating season in Europe.
Yeah, we heard from Jason Bloom of Invesco saying that autumn is going to be a rude awakening for oil and food prices, and that really links into what's happening when it comes to fertilizers as well. We know that ammonia, of course, is part of the mix there, and production taking a hit as a result of these high gas prices. What is going on there?
Well, indeed, the chemical production fertilizers is a very energy-intensive industry, and as is on the front line of actually suffering from these very high gas prices. Yara International said today that we'll have to curb its ammonia capacity just 35% in Europe. And yesterday, we have CF Industries saying we'll have to temporarily halt production of its UK unit. As we see, that's taken a direct hit from very high natural gas prices in Europe. And that's also rolling across other industries as well, especially energy-intensive industries from tin to ammonia to glass and etc.
Yeah, so the fallout continuing. Bloomberg's Anna Shuraevskaya, thank you for the latest on these energy prices and the implications in that example for ammonia. Let's bring back in Aaron Kaptein, Global Head of Economic Research at UBS. Aaron, how are you thinking about the implications then for the broader Eurozone economy, and whether or not the industrial base of countries like Germany can actually survive this crisis?
Well, so we're now forecasting a recession. So we have negative growth in the next couple of quarters. It's still mild because at this stage, all we've taken on board is the inflation impact on real disposable income and the uncertainty effect. So we don't have rationing in the forecast yet, which would make the numbers a lot worse. But when you look compositionally across Europe, so where is that concentrated? It's very much in Germany, of course, where the industrial base is. So the weakest numbers we have are in Germany, and it's Germany that's leading those European numbers lower. I think what's interesting is that, you obviously were looking, or you were talking about sort of the wholesale gas prices, and they're through the roof. But there is enormous amounts of government intervention trying to break that link between wholesale and retail. And if you look at Germany, which is where the weakness is concentrated, even in Germany, in October, the gas levy only goes up by a net 20% if you adjust for VAT cuts and everything else. So 1/4 of what's going to happen in the UK, right? So that's interesting.
Yeah.
But what it implies is that it's the firms in the budget that are absorbing the cost of those wholesale prices. So I think they're trying to shield the consumer, which is the bulk of GDP growth. But then you're actually going to take pain, I think, in margins and in the budgets to sort of compensate for that. And so I think that's why we're getting increasingly worried just about an investment pause and what this is going to do to capex.
So on that point, Aaron, given Germany's historical kind of prudence around its debt levels, what capacity do officials in Berlin have in terms of increasing that fiscal support?
Yeah, so they have plenty of capacity. So debt levels are low. They are, I think, talking about a third package. So they've done 2 so far. But at this stage, they've done, I think, a third of what Italy has done year to date. So there's certainly, I think, scope to roll out a lot more in the remainder of the year. Now, we're going to get the budgets or the draft budgets mid-October, and I think those budgets will reveal what's coming. So, I think it is the route of least resistance, and I think the most likely scenario that all these governments, in response to these higher gas prices, will add stimulus. So I think that's unquestionable. The only question is sort of how much.
Is the window closing on further hikes from the ECB, given the deterioration in the economy?
No, because this is not, there's a slowdown, but it's not deep enough. So, and I think the Schnabel speech from a couple of days ago was very clear on that. So this is, if you're going to have a contraction of, let's say, -0.5% annualized for a couple of quarters, that's just not very disinflationary. And when your starting point is, you're running at close to 9%, and you're probably going to go over 9% in September, and you're worried about de-anchoring inflation expectations, then you basically have to keep going until the recession gets deeper. And so I think we're in this sort of awkward phase where, although growth is going negative, they will just keep going. And so we've got 50 in September, and then another 225s, and then they do another 325s next year. So actually, they'll basically deliver a full cycle unless the growth numbers go significantly more negative.
Okay, so 175, still kind of the best case when it comes to the ECB by the end of this year, given what you've just outlined there.
So, so we get to, as a level, we get to 1% on the policy rate by the end of this year, and then 175 by end of next year. But and then, whether you end up lower, whether you stop out earlier is dependent, I think, on now how much additional inflation pressure do we get. So we, for instance, in Germany, we have a reset potentially of the gas levy every 3 months. We have to see what happens on the gas storage, et cetera, et cetera. So I think there's a lot of moving parts which could change that. But for now, I think they're on track to do 50 at the next meeting and then continue hiking at the subsequent meetings.
Okay, Aaron Kapteyn, Global Head of Economic Research at UBS, always excellent on the views across this economy. Thank you for your insights. And coming up, we're going to talk about the outlook, in fact, for Germany's economy in more detail with the Deputy Director of the IFO Centre after that survey came in just slightly above the estimate. Stay with us. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one, and through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Let's focus in on Germany now. And the IFO Business Confidence Index came in at 88.5 for August. That was ahead of an estimate of 86.8. And earlier this morning, Germany's economy proved at least a little bit more resilient than initially thought by growing in the second quarter, despite, of course, surging inflation and the war in Ukraine. Joining us now for more is Timo Wolmer-Hauser, who is the Deputy Director of the IFO Center for Macroeconomics. Timo, thank you for joining us. Just give us your assessment then of the survey and what it tells us about the fragility of the German economy at this point, as it struggles, of course, with those record energy prices. The survey coming in slightly better than the estimates, but still showing a weakness in terms of confidence.
Yes, that's right. This is the only good news that I can tell you today. The good news is that it is more or less stagnating our business climate index, and this is the opposite to what most of the people expected. But as I said, this is the only good news. The bad news is that the low level of the confidence that we saw in July was confirmed, and in July we really had a crash of the IFO Business Climate Index, and so this of course has implications for the third quarter. So if you compare business confidence of the third quarter with that of the second quarter, then this is clearly signaling a decline in economic activity of the German economy in the third quarter. So after this more or less stagnation in the second quarter of GDP, we expect GDP to decline by around 0.5% in the third quarter.
Given everything that you're seeing, everyone you're speaking to on the ground there in Germany, do you expect that drop in sentiment to continue to get worse in the months ahead? And which sectors of the economy are feeling the most pressure at this point?
Well, the decline in the business confidence is something that we observe over all sectors. On the one hand, of course, the industry is suffering from high energy prices, from slowing world economy, and so here we expect activity to stagnate over the next couple of months. But where the index is declining the most at the moment is in the retail sector, and this is of course to do with the high inflation rates that we observe in Germany, which are clearly weighing on the purchasing power of households. So this is also the reason for why I expect GDP to decline in the third quarter, because of private consumption being weak. Concerning the further outlook, let's say into the fourth quarter, of course, there's a lot of uncertainty at the moment. On the one hand, the uncertainty about how strong the increase in consumer prices will be. There's a lot of price increases still in the pipeline in energy prices. So far, gas prices have only increased for German households by around 50%. This is a large number, but there's still a lot more to be passed through from energy suppliers to households.
Timo, are you seeing evidence of a pickup, an increase in closures, business closures, bankruptcies?
For the moment, I don't see this. I mean, it is not really a severe recession that we are entering. It's not even, 0.5% of decline in GDP. This is nothing which should, in the end up with a high number of bankruptcies. But still clear, this is a weakening of the German economy, and depending on what is going on, especially on the energy supply side, this is the other big thing which is really uncertain. Is there enough energy? Is there enough gas over the winter month? And in case we are entering a rationing system or a rationing situation where some of the manufacturing industries do not get gas anymore, of course the risk that we have insolvencies is of course increasing.
Is there more that the government, that officials in Berlin can do to support industry and business?
Well, the only thing that they can do is of course to increase the supply of gas, and this is what they have done successfully, I would say, over the last couple of months. So, of course, gas imports from Russia were declining significantly, but the imports from other countries like Norway or the Netherlands have increased. So this is one thing that they can do. Of course, we can give incentives to households and also to firms to decrease the demand of energy. This is what the government is currently doing. They are reducing energy demand of the public sector, but on the other hand, what the government can also do is of course to increase the incomes of those households which are suffering most from the high energy prices by increasing transfers to them.
We're running short of time, but we appreciate your insights on the back of this survey. Thank you, Timo Wollmischhauser, Deputy Director of the IFO Center for Macroeconomics. Plenty more coming up. Stay with us. This is Bloomberg.
A push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
No one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming true?
There was something of a grey zone battle between Taiwan and China.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
What is your base case for Italy in terms of what happens politically and then what the economic fallout is?
Welcome back. Will it be a hole in one? Investor attention turns to Jackson Hole. See what we did there? Wyoming for clues on the path of Fed policy. Taking out the toolbox, China pledges more support for the economy, supporting global stocks, plus power pinch. Global gas prices jump to near records as France's Macron travels to Algeria to shore up supplies. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Pressure is growing on the UK government to draw up emergency measures to protect households and businesses from soaring energy costs moving into winter. Household bills have been rising and are set to increase further with tomorrow's announcement by the energy regulator of a new price cap. Let's bring in Bloomberg's Lizzie Burden then here in the London studio. Lizzie, what are you expecting from Ofgem tomorrow?
Well, Ofgem will tell us how much more suppliers can charge customers for their energy bills in the fourth quarter. One estimate based on wholesale gas prices said that the price cap could go up 80% to £3,500, and it's only set to keep on rising next year. And that's why cities forecast 18% plus inflation in Q1 2023. Yeah. You've got an EDF energy boss warning that more than half of households in the UK could be in fuel poverty by January next year. And so this is why it's top of the in tray for the next Prime Minister, whoever that may be, in terms of both how to change the system and in the short term how to help households pay their energy bills. But aside from this, the price cap doesn't even apply to businesses. They don't even have that protection. They're just exposed to the wholesale gas market if they don't have a fixed rate tariff. So you've had industry bosses overnight warning that perfectly viable businesses could collapse unless the government steps in.
I guess the question is to what extent those businesses can cling on until we get that action from the next Prime Minister. Boris Johnson and his team have made it clear they're not going to do anything until the next Prime Minister comes. What do we know about the next Prime Minister, likely Liz Truss, and what the plans are there in terms of addressing this issue?
Well, not much, but there are hints that Liz Truss would do an emergency budget. It might not be called that, but it would be a fiscal package as soon as she arrives in number 10. Rishi Sunak, if he were to win, has said that he would do more targeted handouts for the poorest households, much like he did when he was Chancellor. But there are lots of suggestions going around of things that the next PM could do that frankly were unthinkable until recently. So the former Prime Minister Gordon Brown is talking about nationalising energy suppliers that collapse. The opposition leader Keir Starmer is talking about freezing energy bills, funding it through a continuation of the windfall tax. It would cost about £29 billion. There are even suggestions of having an OPEC for gas to try and manipulate the markets. It might be easier to get the EU on board than the US with that. And then finally, there's this idea of targeted blackouts to reduce demand. So it feels a lot like the 1970s here.
So some thinking out of the box to kind of address this issue. What do we know then about how the UK compares in terms of response versus other European countries?
Well, if you compare the energy price cap to what France has, it's quite similar for consumers. What's different is that France effectively owns EDF, or at least it has huge influence over its power, its price setting. And so in the UK, the debate is, do you keep up what some would argue is a pretense of a retail market, where people are exposed to prices in the good times, and in the bad times, potentially the suppliers get bailed out? Or do you go for a more France nationalisation sort of model? But it's not just how people use, how people are charged for energy, it's also how they're using it. So in the UK, we're much more reliant on gas to heat our homes than, say, Germany or the US. And that's despite the increased use of renewables in the UK.
Okay, Lizzie Burton, thank you very much indeed, of course, on the challenges, the particular challenges for the UK, and how the future Prime Minister, the next, whoever it is, future Prime Minister, of course, of the UK, will address that. Just a line crossing the terminus of Redhead, PetroChina, in terms of income, net income for the first half coming in at 82 billion yuan. The context is that's an increase of 55% year on year, of course, linked to those very high energy prices. And talking and continuing with this story, the energy crisis, of course, as that continues to bite in the UK, across the channel in France, President Emmanuel Macron is also looking for relief ahead of a challenging winter. Later today, he's going to arrive in Algeria, the former French colony, and one of the world's largest gas producers. For more on this, let's bring in Bloomberg's Caroline Conat in Paris. Caroline, what are the official reasons, and maybe the unofficial reasons, behind this trip?
The official reason is to improve the relationship with Algeria. That's been damaged recently by a lot of diplomatic tensions over visas, tensions over Algeria recalling their ambassador in France last year. And of course, this anniversary this year, the 60th anniversary of the independence from Algeria from France, that is of course still in everybody's minds. But behind this, Algeria is indeed the third biggest gas producer and actually provider to Europe through 3 pipelines. 2 go to Spain, 1 go through Italy. They also have some LNG tankers that could arrive in France in the port of Marseille, which has 2 big LNG facilities. So Algeria could technically provide more gas to France, to Europe. Algeria produces about 100 billion cubic meters of gas. That was the number of last year. And the Sonatrach head said at the start of the war in Ukraine that they could potentially increase this capacity and were ready to provide more gas to Europe.
And can they increase that capacity ahead of the winter and help, at least around the edges, solve France's energy crunch?
The problem for Emmanuel Macron and for other countries in Europe is that Italy has already taken a lot of the extra capacity, because Italy has this very convenient pipeline called Transmed that goes directly undersea from Algeria to Italy. And last month in July, Mario Draghi went to Italy and there was this $4 billion deal signed between Eni, Total and Sonatrach, the Algerian state-owned company, for an extra 4 billion cubic meters of gas provided by Algeria to Italy. So basically a lot of the extra capacity is already taken by Italy. France could also import more via the LNG tankers, but the Sonatrach head has warned that the liquefaction plants in Algeria can only operate at about 50 to 60% capacity because they need more investments. The good news is that the Algerian government has planned about $40 billion of extra investment over the next 4 years in oil and gas infrastructure. So in fact, Algeria and the Algerian president may also call Emmanuel Macron for financial help in terms of investments if they really want to see this capacity increase over the next few months.
Yeah, a quid pro quo there, maybe, from the Algerians. OK, we'll continue to watch that. Caroline Conat in Paris with a preview of that visit by Emmanuel Macron to Algeria. Coming up, we will talk summer travel and the outlook for the rail industry with Jodie Ford, the CEO of Trainline. That is next. This is Bloomberg.
very popular. And if a client came to you and said, look, I'd like some cryptocurrencies in my portfolio, what would you say?
Oh, we've actually been really deep into crypto, deep into learning about blockchain, and all of the new businesses. You know, I would characterize us as crypto learners. You know, we have made a series of toehold investments on behalf of our clients, both in some of the currency baskets as well as with some venture firms that are investing primarily in the crypto area. I think it has the potential to be completely game-changing, but it is still such the Wild West, and it's so uncertain. But it has the potential to completely upend everything.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
Today, as the world watches inflation rise, employment rebound, and fiscal policies react, all roads lead to Jackson Hole for the Kansas City Fed's 2022 Economic Policy Symposium. Bloomberg's all-star team is live as policymakers and financial insiders discuss the economic issues and solutions that keep the world's money moving. Coverage starts today on Bloomberg Television and Radio.
Welcome back. Economics, finance, politics. This is Bloomberg Surveillance. Early edition. I'm Tom McKenzie in London. Now, it has been a mixed summer for the rail industry. Ridership is down following deep structural changes as more people work from home, and those who do travel have been disrupted by strikes. But there has been a big rebound in tourist inflows as visitors return after 2 years of COVID-related restrictions. For more on all of this, then, we're bringing in the CEO of Trainline, Jody Ford, here in the studio. Jody, thanks for coming into the studio. Let's just start with the top line in terms of what you're seeing. Activity post-COVID, some revenge spend from travellers, and whether or not you think it's going to be sustained.
So it's really encouraging. I think the big story here is that in the UK market, we saw data at the end of July, 94% back in terms of passenger volume. So sort of squint, and there's a recovery. That's been led by leisure travel, which has been very strong. But the other part of this, which is interesting, is international inbound tourism, particularly from the Americans, who have come in very strongly, not just to the UK, but also we sell tickets in Italy, in France, in Spain. We've seen the numbers of inbound Americans coming in double versus pre-COVID into France and indeed into Italy.
But how much of that is going to be short-lived?
Look, it looks very encouraging in terms of those trends. I expect the UK recovery just keeps going up in terms of leisure. We're now north of where we were pre-COVID. And when you look at the inbound tourism, there's this broader theme of wanting to use rail and get off the plane, which is, we hear it all the time, and I think it's an increasing trend. So I expect those numbers to keep going up into next year.
Okay, so there's the leisure component looking very positive, but it's undeniable, but the work from home shift has led to this structural change in terms of the number of commuters on rail. And then, of course, you couple that with the strike action that we've seen. I've had to get a car 3 times when I would have preferred to get the train this year. Those issues continue, and how much of a drag do you see that going forward, longer term, the structure changes, and then this industrial action on the railway?
So for the industry as a whole, I think the good news is that leisure has come back so strongly that we are at this 94% number. Yeah. I do think, as you say, there's a new way that people will work, and one of the things that we're doing here is actually bringing in a kind of electronic season ticket, getting rid of that paper season ticket, so that actually you can begin to scan and go, and it's things like this that reduce the friction of, I think, the commute, which will help commute recover, and we have seen that continue to recover, and I think we'll have to wait and see next year exactly the big employers and what their policies are, quite where it ends up, but I do expect further recovery.
What is the hit to Trainline from a strike?
So we don't sort of talk about those numbers. What I would say is when we pull back, we've been really encouraged with the overall recovery, and that's been ahead of our expectations with that 94%.
Do you get a sense that the industrial action is going to come to a conclusion? What are you hearing?
So look, we kind of hear is in the end, we just work with our customers through the strike action. Our focus is always about trying to remove the friction for them to change their ticket and support them in what is a difficult and frustrating time for them.
Talk to us about competition as well. You've got Uber Travel coming in. They're offering some tickets for example, UK to France travel. How much of a threat, how seriously do you take that?
So look, we actually think competition's a good thing, and particularly in these European markets. What we're seeing here is that the state incumbents has been the only way that customers have thought about buying train tickets. Trainline has got what I believe is the best app in Europe, and actually disruptors coming in and telling people there's alternative choices is very encouraging and really exciting. And I think one other trend which is big here is the competition beginning to emerge between European capitals as challenger brands come in. So between Madrid and Barcelona, by the end of the year, there'll be 4 different services that a customer can take. And in that situation, they need someone like Trainline to sort of explain all the different train times, all the different prices and services. And we think there's an increasing role for us as an aggregator in those markets. In fact, Madrid-Barcelona is up 5x for us versus pre-COVID.
What are your key international markets then at this point?
So we're focused on Italy, France and Spain.
How much of that is down to what's happening in the UK with Great British Railways, the plan there, posing potentially a threat to Trainline in terms of some of the pricing transparency that comes through and the formation of that new plan?
So I am bullish on in terms of the UK market and our ability to continue to innovate and grow for customers, bring in new products like the season ticket I just talked about. But also the European opportunity is very significant. We're targeting to do €1 billion of sales this year in Europe.
Okay, €1 billion of sales in Europe. One last one, in terms of the heat waves we've seen across the UK, and that's driving people to the beaches and other tourist destinations. That's been a benefit, presumably, in terms of the demand for travel. Do you expect those changing kind of weather conditions to play a factor longer term as well, or is this a one-off?
So, look, who knows quite how the weather evolves, but what we do see is that leisure travel is back in a big way. That has driven it. The heat helps, of course, and we think that the leisure on rail will just continue because people are increasingly, especially when you compare it to car ownership and kind of petrol prices, people increasingly seeing rail as a way to travel with great value.
Okay, Jodie Ford, CEO of Trainline, thank you for coming into the studio, walking through what's happening in that space, even as, of course, industrial action continues across the rail lines here in the UK. Let's get to your Bloomberg Business Flash now with Leanne Gerrans. Leanne.
Good morning, Tom. Novartis says it is planning to spin off its Sandoz unit, creating the largest European generic drug company by sales. The Swiss pharmaceuticals giant is refocusing to concentrate on developing and delivering breakthrough medicines. The separation should be completed by the second half of 2023. AIA Group has reported a 15% fall in new business value in the first half of COVID lockdown dented insurance sales in mainland China. The Hong Kong-based insurance giant has long taken pride in an agency workforce that sells more profitable products than its peers, but that strength has worked against it as China locked down major cities. And Peloton shares have surged the most in 6 months after the company announced it will sell its exercise bikes and accessories on Amazon. Peloton products were previously only available via its website and retail showrooms. The one-time pandemic darling has been struggling with slowing demand and inventory buildup and strategy changes. And that's your Bloomberg Business Flash. Tom.
Leanne, thank you. Okay, coming up, all eyes on Jackson Hole. We're going to be breaking down the economic symposium next with Bloomberg Opinion's Marcus Ashworth. This is Bloomberg.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
It's gorgeous, but not luxurious. Jackson Lake Lodge is where economists and central bankers gather every year, not for the accommodations, but the conversations. Housed not in fancy hotels, but rustic cabins, they come for 2.5 days of eco-nerd talk about math-dense academic papers. They meet in this functional conference room, not quite the same as the electronically wired, mahogany-paneled Fed conference room back in Washington. For Global Wall Street, it's not about the conversations or the accommodations, but the implications. The papers don't matter much to investors, but the policymakers' comments on TV and in print do, particularly the Friday keynote by the Fed chairman. Talk of inflation, unemployment, recession, and what it all means for interest rates and profits. Now, we're here because of Paul Volcker. Back in 1981, the Kansas City Fed wanted a big name for their new conference. They came to Jackson Hole because the trout fishing is great, and Volcker loved to fish. The rest is history. The irony is this year, the financial world is wondering whether current Fed Chair Jay Powell will be Volcker-like in committing the central bank to fighting inflation above all else, even if it results in recession. If he isn't, stock markets might fall. And out here they know, you don't feed the bears. Michael McKee, Bloomberg, Jackson Hole, Wyoming.
Okay, at Jackson Hole, Bloomberg Opinions, Marcus Ashworth now. Let's bring him in, calling for an honest reflection on the causes of the rampant inflation the world is currently battling. We can read out some of this. Of course, Mike McKee talking about the potential Volcker moment and linkages to the formation of Jackson Hole as the location and how that ties into Volcker and whether or not you get to see a Volcker-esque Jay Powell. The quote here from Marcus Ashworth then, now it's time to take away the punch bowl. Let's hope the unity shown between central banks during the pandemic is mirrored, but that needs to start with clear communication of what has gone wrong as well as what needs to be done to fix it. It needs to be a mea culpa from officials at Jackson Hole. Let's bring Marcus Ashworth in at this point. Marcus, what do you hope then to hear from Jay Powell and team?
Well, I don't think we're going to get any of that, unfortunately. I just would like to see it. But we're going to get a hawkish Jay Powell, because he sort of has to be, because every time he says anything other than extremely hawkish, and bear in mind, at least the Fed are all in unison, and even the doves like Neil Kashkari are being overtly hawkish, because they're trying to get their message across, and the market keeps on looking for some evidence of a dovish pivot, which is, I think, why Powell is boxed in a bit here. He's got to be pretty harsh, and at the same time, I think they will also hike 75 basis points rather than 50 next time round. But it would be interesting to see a proper clarity, which Powell has started to give at Sintra, the last ECB forum, the last big sort of powwow. He mentioned that basically they don't know anything about inflation, realised how little they knew, and they're starting to get a better grip on it. But a bit more of that as to why they got inflation expectations so wrong. Bear in mind, this time last year, he stood up at Jackson Hole and said, effectively, inflation was transitory. That hasn't tested very well over history. So I think we can get something from him that there is a balance, there's a trade-off between crashing the economy or fighting inflation, which is very largely supply side. Would that not make it worse, like Joseph Stiglitz said yesterday?
Does Andrew Bailey of the BOE set out the guide rails for how to be more honest and more frank about the challenges?
Sometimes you can, actually. To be fair to Bailey, he does couch it in rather complicated terms and perhaps isn't the most approachable. But every now and again, they do actually say, look, we don't fully understand this and we are trying our best. And I think a bit more of this from all of them, just to say, look, and in fact, even Lagarde has come out and said that they basically don't look at their models, just their models, because evidently they've been proved very wrong. So we're getting there a little bit more, a place like Jackson Hole of full look. We got this completely wrong. The reasons why we got it wrong, we're not trying to sort of humiliate ourselves, but we can educate everyone and ourselves. And only then, I think, can we get a real buy-in into, yes, we will have to see unemployment go up, the economy crash a little bit, and stocks may suffer.
Marcus, we hear from the likes of UBS, we hear from the likes of BlackRock saying that we are in a new inflationary dynamic, that we're not going to be getting back down to that 2% target. It's going to be more like 3, maybe 4%. Does there need to be honesty about that? Is that an impossible admission from the Fed?
Well, I think that's exactly the type of stuff that we have to hear. Is that if it's going to be, how long will the medicine take, and how bitter will it be? And I think as long as there's some explanation of that, we understand what we can do with inflation, and equally what they can't, therefore what they're prepared to weather. I mean, I've long argued that a very fixed 2% inflation target, it isn't fit for purpose in the current environment. We need to have a more flexible one, but that needs to be matched with an idea of what's going to happen to money supply, and yes, that there is important monetary indicators, as well as things like nominal GDP. That this needs to be a franker, more open, and I think that will lead for a better policy overall. Okay.
Time for a mea culpa from the Fed and co. Bloomberg Opinion's Marcus Ashworth there. You can read more sharp insights, of course, from Marcus and the Bloomberg Opinion team by typing OPIN GO on your terminal. Futures stateside pointing up by 0.8%. Bloomberg Surveillance Early Edition continues. This is Bloomberg.
The 700th anniversary of Dante Alighieri's death has triggered the work of many institutions and offered a very rich schedule of events. Today in Santa Croce, we present one of these projects that suffered a difficult start because COVID-19 has stopped the project that was shared by the Opera di Santi Croce by the Franciscan community from Florence Municipality and the Fund for Religious Building of the Internal Minister. Today, Felice Limosani's project is finally enjoyable. In the Pazzi Chapel, the marvelous architecture by Filippo Brunelleschi, the most important images from the Divine Comedy created by the French illustrator Gustave Doré. Through these images, we can live the violent emotions of hell, the weight of purgatory, and the sublime joy of paradise.
The digital humanities are a cultural occasion to exploit. Summing up, it's about merging humanistic disciplines with new technologies. I find this to be an innovating and modern tool to update culture. Cultural heritage becomes something to hand over to the new generations and not to be put aside. So it's about using technology, pixels, and binary code with a human and humanizing content.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrell. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg.
Ken Griffin is moving both Citadel and Citadel Securities to Miami. The scoop was broken by Bloomberg's Amanda Gordon.
Clearly, last year, the Fed was really off its mark.
There is a divergence between the Fed and the market.
I think we're going to be at 4%.
To me, this whole argument that they should, hike well beyond 4% doesn't make a lot of sense.
Our view is that the Fed basically stops by the end of the year. I mean, you're going to be at 350, and the hiking cycle is going to be done.
Raising interest rates doesn't solve the supply side problem. It can even make it worse.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. China tries to revive a sluggish economy. Beijing adds $146 billion of funding aimed at infrastructure. But will that be enough to overcome lockdown damage and the property market slump? Investor sentiment is shifting as we wait for that crucial speech at Jackson Hole from Fed Chair Jerome Powell. Bloomberg Surveillance is on location with special coverage. And Europe's energy crisis, the $279 billion that politicians have earmarked for easing the pain may not be enough. Energy ministers in Europe consider an emergency meeting while natural gas prices continue to soar. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta and Kaylee Lines in New York. Matt Miller is off today. Well, it's finally here. Jackson Hole, that symposium has arrived. Kaylee, we finally get to see Mike McKee wearing a Stetson. And markets seem to be in positive mood. I don't think the two are connected.
Yeah, well, of course, markets have been eagerly anticipating this Fed symposium, but you also have to take into account the news out of China overnight when you think about the risk sentiment that definitely seems to be prevailing today. It certainly prevailed in the Asian session as they digested news of more stimulus from China, $146 billion, mostly targeted at infrastructure spending. The question, though, is how far can that really go to help the Chinese economy, which is still dealing with COVID-0 policy and turmoil in the property sector. So that's why you see Chinese stocks only up about 0.8%. Yes, a move further into positive territory, but it was actually much more muted than what we saw in Hong Kong, which was a delayed session due to a storm, but a big move for the Hang Seng, up about 3.6%. And as for in other asset classes, how that Chinese stimulus news was feeding through, you did see bond yields moving up about 2 basis points on the 10-year in China, which now trades just shy of 266. And the Chinese yuan, after falling to its weakest level against the U.S. dollar in 2 years yesterday, is gaining a bit of strength back, right now trading at 685.89, Kriti.
Yeah, Kaylee, I think it's fair to say that sentiment has clearly gone across Atlantic, or across Pacific at least. We'll get to the European session in just a moment. But take a look at this. The S&P futures are up about 0.9%. Already you are seeing a pretty positive session. It's kind of hard to put that on a fundamental reason here stateside. So it must, of course, be the China story as well. That stimulus once again pushing this risk sentiment higher. But take a look at this. 10-year yield is really where it gets interesting, because at the same time they see that risk-on vibe in the stock market, you're not necessarily seeing it in the bond market. In fact, 10-year yield hovering around 308 for our radio audience, about 2 basis point move lower. And with those yields coming lower, the dollar follows. You do see weakness in the greenback, down about 0.4%, which once again could be going back and feeding into that strength that you are seeing in the stock market. Remember that inverse correlation remains strong between the dollar and U.S. stocks. So remember, certainly feeding back. And of course, Bitcoin, that risk sentiment indicator, not flashing green, not flashing red, just about unchanged on the day, still trading with a 21,000 handle, Anna.
European stocks, though, Chrissy, to your point, not unchanged, showing some signs of life. European stocks moving higher, up by 0.7% on the UK market. The DAX over in Germany, 0.6% higher on the CAC 40. And some of this comes down to that Chinese data that Kayleigh was talking about, or Chinese news flow, rather, about support, 19 measures being announced by the PBOC. That set the positive tone through the Asia session, which then filters into the European trading day. But we also got some data out of Germany. And yes, sentiment around business executives deteriorated, but maybe not as much as some had expected. Is that a silver lining, or just a some calm before yet another negative storm? We'll see. One thing that's been causing a lot of negativity around the European story, of course, has been the higher gas prices, and that continues to be a story today. This is the benchmark for the Eurozone, and it is up another 8.5%. It's certainly making moves above 300 euros per megawatt hour, which has been something of a level to watch of late. That was a big story yesterday, of course, as well, and we watched as that put upward pressure on short-end yields in Europe. In the UK, in the Eurozone, it was a similar story. Those gas prices going higher, assumptions about inflation going higher, and therefore assumptions about rate hikes going higher. And that certainly was the case in the UK yesterday. So we saw those yields going higher. Today, we're pulling back then a little bit from those trends of yesterday, which were quite pronounced. I put Yara International in. This is a Norwegian-based business, a really big player in the fertilizer market here in the European part of the world. And of course, fertilizer has been under pressure on the cost front because of the higher price of gas. And they've said today that they are going to reduce their utilization in some of their ammonia facilities. And this is an ongoing story, one we're tracking, set to put pressure on some in the agriculture space. CRH, an Irish building supplies business, they managed to increase their margins despite all of the cost pressures that kind of business is facing. They're passing those on to their consumers, and they're managing to increase margins, and that's going down really well with investors, Kayleigh.
All right, Anna. Well, let's talk about what is ahead today, because other than being Jackson Hole Day, there is a lot else going on, including from another central bank. The ECB will be publishing an account of its July policy meeting at 7:30 a.m. New York time. Plus, French President Emmanuel Macron will be starting a 3-day trip to Algeria, which is one of the world's largest gas producers. We'll get some economic data here in the U.S. GDP figures coming at 8:30 a.m. Eastern. Plus, Peloton will be reporting its earnings results before the bell. But of course, Treaty, as we've said, Jackson Hole is the big event of the day, kicking off as central bank watchers will be following for clues on the Fed's September meeting.
And surely something that's going to move the markets. But let's go back to what's moving the markets this morning. It all comes back down to China stepping up with more stimulus to stabilize its slowing economy. It's adding $146 billion of spending, largely focused on infrastructure. Enda Curran, our chief Asia economics correspondent, joins us now from Hong Kong. And walk us through the details.
So it's another wave of stimulus for China's economy. It speaks to urgency now among the government to try and get more money into the economy. It will come through two channels. State policy banks will invest in new infrastructure projects on one side, and on the other side, local governments can spend on infrastructure projects as well and speed up their spending to get shovel-ready projects off the ground. Now, at the same time, though, the government said they don't want to overdo their stimulus. They want to keep an eye on the overall level of borrowing that they are putting into the economy, and a lot of economists then reacted to say maybe this won't be enough to turn things around. Goldman Sachs, for example, saying China forecasts still looking at 3% of GDP growth this year. So on the one hand, it's clearly new money. It's an indication of urgency among policymakers. But most economists today saying it won't be enough to turn things around on its own.
Yeah, which is the key question, of course, up against those COVID rules. Enda, thank you very much. Bloomberg's Enda Curran joining us there with the latest on China. Let's think about the Fed and Jackson Hole. Central bankers from around the world gather for the Fed's annual Jackson Hole Symposium, which kicks off today. The spotlight is on Chair Jay Powell and just how hawkish his message might be. Joining us now for more is Bloomberg's Michelle Jamrisco. Michelle, what is the latest on what we can expect out of Powell and all of the other Fed voices at Jackson Hole?
Well, Anna, of course, all eyes on that Jay Powell speech Friday, 10 a.m. Washington time. It seems like there's an increasingly small margin of error for Powell to satisfy the Fed watchers in this case. He's going to disappoint a large swath of Fed watchers in any case. But what to expect? Expect a hawkish Fed. Expect Powell and company to kind of reiterate their message. As futile as it might be to convince investors of their strategy, they do want to keep pushing back on this idea that they'll slow walk or even stop rate hikes sooner than they've said. Also, the the idea that they might pivot to rate cuts. Some investors looking at early 2023 for that. They'll push back hard on those insinuations. Expect ongoing disagreement also among attendees about recession risk and also the timeline of how long these rate hikes will last. Of course, the other nugget out of the Fed minutes that we'll be watching is, who has this concern beyond Esther George, as we know, about the long and variable lag of monetary policy and needing to wait and kind of see what the impact of rate hikes already has been before they move further or move at the same pace that they have been moving. Expect many big picture debates, the whole Volcker era debate around inflation, a lot of historical parallels and questions around, whether the Fed is doing the right thing by, from the big picture perspective. And finally, expect a fun crowd at Jackson Hole. We know ECB, BOE, BOK representatives will all be there for one thing, and it's always a great time. So it'll be the first in-person annual confab since 2019, so a lot of people will be there excited.
Yeah, and I'm sure Tom, John, and Lisa, Team Surveillance, will be adding to that fun crowd. Michelle, you mentioned that some Fed watchers are going to end up disappointed. Are there things that they would like to hear that they probably aren't going to get?
Well, first and foremost, don't expect Powell to give any sort of certain indication or confident indication of the size of the rate hike in September. I mean, a lot of people looking at 50 or 75, that being the big debate right now. We still have a ton of data before him then, aside from a ton of other things that could happen between now and that September 21st decision, namely PCE, inflation, the Fed's preferred gauge is out tomorrow. We have a jobs report and CPI data before then. So plenty of drama ahead. I don't think they're going to, signal any commitment in one way or another tomorrow.
Michelle, thank you very much. Bloomberg's Michelle Jamrisco. Our special coverage of the Fed's annual symposium in Jackson Hole starts today at 6 a.m. New York time. Tom, John, and Lisa will be there. They'll be hosting Bloomberg Surveillance on location, live from Wyoming. Now, confidence in Germany's business outlook fell in August as soaring inflation and fears about a possible recession intensified. The deputy director of the IFO Center for Macroeconomics spoke earlier on Bloomberg.
If you compare business confidence of the third quarter with that of the second quarter, then this is clearly signaling a decline in economic activity of the German economy in the third quarter. So after this more or less stagnation in the second quarter of GDP, we expect GDP to decline by around 0.5% in the third quarter.
European natural gas prices have been extending their blistering rally as the worst supply crunch in decades boosts pressure on politicians to ease the pain. European Union energy ministers may hold an emergency meeting to discuss the price spikes. Bloomberg's Lizzie Burden joins us now with more. A lot of expectation then on governments around Europe to do more here, Lizzie.
Yes, because you're seeing spiralling prices toward record levels in Europe and Asia because of Russia's curbs and the outages elsewhere. But really the reason for the surge in Europe is because of the competition with Asia. You've got benchmark futures near the level at the start of the war in Ukraine, and because of this rise in energy prices, the pressure on inflation, the recession risks across the euro area, you've got risk of civil unrest and political upheaval. So that's why EU energy ministers are considering meeting up to debate an energy price cap across Europe. We really don't have much more detail than that at this stage, but France has said, even though it's very much aligned with the EU on energy policy, it may not back the logic of a Europe-wide price cap. Although Emmanuel Macron, the French president, has said that Russia's weaponization of gas is, to use his term, a tipping point for Europe.
All right, Bloomberg's Lizzie Burden, thank you so much. Let's bring it back to the United States now. President Biden's plan to forgive a portion of student loans held by tens of millions of people will ripple through the economy. But no factor will be watched more closely than inflation, which is already at a 4-decade high. Biden announced his student debt relief plan yesterday.
An entire generation is now saddled with unsustainable debt in exchange for an attempt, at least, at a college degree. The burden is so heavy that even if you graduate, you may not have access to the middle-class life that the college degree once provided.
Jack Fitzpatrick, Bloomberg government reporter, joins us now from D.C. with more. So, Jack, it took the president a long time to come to the decision to make these moves. How's it going down in Washington?
It was some mixed reviews on Capitol Hill, especially if you try to figure out how this plays among the moderates who weren't sure what to make of this plan. This is a popular move with the progressives who actually pushed for more, pushed for up to $50,000 of debt forgiveness. But if you look at someone like Senator Michael Bennet from Colorado, who's in a tough re-election race, he said this should have been targeted more, looking at that $125,000 income cap. Someone else like Senator Maggie Hassan, another person with a tough re-election race, said this was a pretty good compromise. This was not everything that the Elizabeth Warren types wanted, although it was something progressives were significantly more happy about. And of course, among economists and people trying to do the math in the early days after this announcement, it did get some pushback from moderate Democrats, people like Jason Furman, saying this doesn't make a lot of sense when inflation is a key concern. So it's something Democrats are fairly happy with, despite some heartburn among the most moderate, vulnerable Democrats in the early response to this.
Jack, let's go from the current president to the former president. Today also marks a key deadline when it comes to the affidavit that has to do with the search of President Trump's Mar-a-Lago home. What can you tell us?
Yeah, today at noon is the deadline for the Justice Department to send their proposed redactions to the federal judge in Florida, who said they do have to put out at least some of the information from that affidavit that is the justification for their search warrant to search Mar-a-Lago. The judge in this case noted that DOJ argued it would take too much time and work to go through all those potential redactions, and he rejected that argument. And then the other piece of information we've gotten from the judge since this initially came out a week ago was that he has looked at that affidavit and said that the information in it does appear to be legitimate. So there's a little bit of an endorsement from the judge just in the veracity of the claims in the affidavit that underpinned that search warrant, which shouldn't be surprised because they did get the search warrant. So we don't know exactly how much the judge will agree to redact, but those proposals are due from DOJ at noon today.
All right, well, we'll look out for updates. Jack Fitzpatrick of Bloomberg Government, thank you so much. Now let's get an update on some stocks moving in pre-market trading here in the U.S. I want to begin with NVIDIA, the big U.S. chip maker, one of the biggest stocks by market cap here in the United States. It disappointed after the bell yesterday. What's interesting is they already had warned 2 weeks ago that their revenue for the second quarter was going to disappoint, but the third quarter forecast also coming up short. The real issue for this company is gaming chips and a slowdown in that market in particular. The lower than expected forecast may indicate that that slowdown is going to persist for some time. So that stock is down a little more than 3%. Also lower after results is Salesforce. Its guidance also disappointing. It trimmed its revenue forecast for the full year, shows that maybe businesses are pulling back on spending on business software in a softer economic environment. That stock definitely softer this morning, down about 6.6%. What's interesting, though, is apparently businesses are still spending plenty of money on cloud software because a company in that space, Snowflake, also reported yesterday and beat expectations by a pretty wide margin, and that stock getting nice reward this morning as a result, up about 18% before the bell, Anna.
That is a sizable move. Coming up on the program then, Kaylee, markets counting down to Powell's speech at Jackson Hole. We will speak to Ryan Wang, US economist at HSBC, find out what he expects. This is Bloomberg.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, We want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
Yes, it's about renewables.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Today, as the world watches inflation rise, employment rebound, and fiscal policies react, all roads lead to Jackson Hole for the Kansas City Fed's 2022 Economic Policy Symposium. Bloomberg's all-star team is live as policymakers and financial insiders discuss the economic issues and solutions that keep the world's money moving. Coverage starts today on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Kriti Gupta in New York and Anna Edwards in London. Matt Miller is off today. Now keeping you up to date with news from around the world, here's the first word. The Biden administration has won a judge's order ensuring women in Idaho can get abortions in medical emergencies. That came less than a day after the administration lost a similar fight in Texas. The mixed outcomes point to hotly contested court battles ahead. Bed Bath & Beyond is closing in on a lifeline from Sixth Street Partners. Bloomberg's learned the home goods retailer is in talks for a new line of credit that may be around $375 million. That will give Bed Bath & Beyond breathing room while sales slump and it burns through cash. Bloomberg's learned that billionaires Ted Leonastis and David Rubenstein are considering a bid for baseball's Washington Nationals. The Nationals are said to be worth $2.2 billion. The two men may also put in a bid for the Baltimore Orioles if that team comes up for sale. And in the UK, two research groups say the government will have to draw up previously unthinkable measures on the energy crisis. The Resolution Foundation and the British Chambers of Congress are calling for COVID-style emergency support to deal with soaring costs. Natural gas prices are now 10 times higher than the last decade's average. So coming up, we'll talk more about how gas prices are weighing on the European economy and on the markets. We'll have more coverage next. This is Bloomberg.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
No one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming true?
There was something of a grey zone battle between Taiwan and China.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kaylee Lyons in New York and Anna Edwards in London. Matt Miller is off today. We are simulcast on TV and radio. As we talk about financial conditions tightening, a big part of that is going to be the credit spread story that Bob Michael over at JP Morgan says could only get higher from here. Let's bring in Laura Benitez, our Bloomberg credit reporter, joining us now to really dive into all of this. Laura, thank you as always for joining us. Walk us through the dynamics in the credit market. To what extent is what the Fed doing mispriced?
Well, as you know, stocks have been on a much stronger footing this morning, and credit has followed that to an extent. But credit has a more holistic approach generally, and there is a lot of nerve still baked in, saying that some key risk gauges have started to fall this morning. So it's looking a little bit calmer for now, but obviously all eyes will be on the Powell speech tomorrow.
Bit calmer for now. September is clearly very busy, usually in credit markets. Does this September look as if it will be busy, or are businesses put off from raising money right now?
It's a really good question because it's normally the busiest month of the year. It's really difficult to say how this month will look, but investors that do have higher cash balances than usual because they've been kind of reserving cash. So there is cash in the system. If we do see some stability in the market, we could actually see some sales. But for the higher risk junk bonds, I think it's quite touch and go, and we'll see how it goes, I think, throughout September.
Okay, Laura, thanks very much. Thank you for joining us. Bloomberg's Laura Benitez with the latest on the credit markets. And of course, the countdown to Jackson Hole continues. More on that shortly. The surveillance team, of course, on the ground, bringing you live coverage of the Jackson Hole Symposium from today onwards. And for market analysis, check out MLIV Go. That is the function to use on your Bloomberg terminal. We will come back with further look ahead, further detail around Jackson Hole. What is the expectation over at HSBC for what we should hear and what we will hear from Jerome Powell? Does the Fed need or want to reset market expectations around Fed hikes? Will we get any detail around Fed hikes and the size and scope of those? Our colleague Michelle Jamrisco telling us earlier on that was not very likely. Stay with us. This is Bloomberg.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund just typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Jim Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. China tries to revive a sluggish economy. Beijing adds $146 billion of funding aimed at infrastructure. But will that be enough to overcome lockdown damage and the property market slump? Investor sentiment is shifting as investors wait for that crucial speech at Jackson Hole from Fed Chair Jerome Powell. Bloomberg Surveillance is on location with special coverage. And Europe's energy crisis, the $279 billion politicians have earmarked for easing the pain, may not be enough. Energy ministers in Europe consider an emergency meeting while natural gas prices continue to soar. I'm Anna Edwards in London with Kriti Gupta and Kaylee Lines over in New York. Matt Miller is off today, and the mood a little bit more buoyant today in markets, Kriti.
It absolutely is, and a lot of this comes from overseas, really. The idea that China is pumping more stimulus into its economy. Well, it flew into Europe, it also flew into the United States, and that's really what you're seeing when it comes to the S&P 500 futures, up about 0.6%. But Anna, I will say, in just the last 30 minutes that we've been checking markets, you are seeing perhaps a little bit of that momentum fading just a touch. I'd argue even that Bitcoin's starting to slump a little bit, down about 0.2%. About 30 minutes ago, it was unchanged on the hour. And at the same time, you are seeing yields inch just slightly lower. We are now down about 3 basis points on the 10-year yield, 307 for our radio audience. And on the Bloomberg Dollar Index, well, it is following weaker by about 0.3%, Kaylee.
Well, Kriti, of course, there's also still earnings to keep on top of, even though the season almost entirely is over. NVIDIA reported after the bell yesterday. The big U.S. chip maker had already pre-warned that revenue for the second quarter was going to disappoint. Now its revenue forecast for the current period also disappointed. The slowdown in gaming chips is really the problem for that company, and that stock is down nearly 4% as a result. Other big tech players, though, are doing fairly well in early hours this morning, including Tesla, which now is trading with its stock split effective. So the shares right now at 301.50. Yesterday they were closer to 900, but that 3-for-1 stock split bringing that price down, maybe bringing more retail traders into the action. It's up about 1.4%, while Apple is up about 0.7%. And it is a much bigger move in early hours for Snowflake, the cloud software company, giving a better than expected forecast. Shows businesses maybe are still spending on technology and cloud infrastructure and software, considering the benefit for Snowflake. That stock up about 17% before the bell, Anna.
Yeah, that's a sizable move, Kaylee. Here in Europe, we are, to Kriti's point, seeing a little bit of a pullback in risk appetite, but still positive across European equities. We're up around 0.3% on the Stocks Europe 600 right now. And part of the reason we are pulling back could be around ongoing nervousness around gas prices. That has been a theme of recent months, of course. And this is the benchmark gas price. We saw it go above 300 euros per megawatt hour in yesterday's session, and it continues to trade above that level, up another 8% in just today's session. And as we were hearing from our colleague Lizzie Burden earlier, there is now an expectation that we might see more fiscal help and we might see an emergency meeting from European leaders. The cost of doing business, because this is something that doesn't just affect consumers but also businesses, is evident in these two stories here. Yara International is a fertilizer maker over in Norway, a big player in the European agriculture space. They've announced they're reducing the capacity utilization of their ammonia facilities. They face higher gas prices. CRH is a building materials company based in Dublin. That stock up by 2.5%. They are managing to pass on some of their costs, reporting higher margins today, and that is something that has pleased investors, it seems, Kriti.
Well, the question here is, will the Fed please investors stateside? At least all eyes right now on the Jackson Hole Economic Symposium kicking off today. Fed officials over the past couple weeks have weighed in on their next move.
The question right now is, can we bring inflation down without triggering a recession? And my answer to that question is, I don't know.
The scale 50-75 doesn't just depend on a data point, even an important one like the CPI.
Although we still have about 4 million people out of the pre-pandemic workforce, we continue to see strong employment gains and low unemployment rates.
I have a baseline case going into September that is 50 basis points. That's where I've been since the last meeting. But I have an open mind about whether 75 is going to be necessary, and a lot of that will depend on the labor market.
I think it'll be 3.75% to 4%. So sort of a 4% top funds rate at the end of next year is what I'm thinking about.
The idea that we are going to start cutting rates early next year when inflation is very likely going to be well in excess of our target, I just think it's not realistic.
Ryan Wang, U.S. economist at HSBC, joins us now. Ryan, thank you as always for making the time, getting up early for us. Let's start here what we're expecting to hear from Jackson Hole tomorrow, specifically from Chairman Powell. A very hawkish market going into this event, going into this speech. To what extent is the Federal Reserve set up to fail?
Well, that's a good question. I think one key challenge for FOMC policymakers is, even though we already have started to see some signs of economic slowing, that doesn't really answer the question about how long it's going to take to resolve some of these supply-demand imbalances in the economy. You know, whether you're talking about the labor markets, logistic markets, product markets, all of that continues to show signs of tightness, and that's the key question. How long will this current period that we're in take to resolve those issues?
Well, speaking of tightness, let's talk about the liquidity picture. We are looking at historic quantitative tightening, something that experts on Bloomberg Television have over and over again warned about in terms of what the Fed is taking on and the implications for the markets. How successfully can they actually pull off the amount of quantitative tightening they're doing right now?
Well, this is interesting as well. After all, you know, the quantitative tightening plan that we're on was only formally announced in May, and we're only just about to see that step up to the new higher pace of balance sheet reduction. The plan all along has been to let that reduction in the balance sheet run into next year and evaluate broader financial markets, money market conditions, as well as the economy. Now, the primary focus from an economic perspective for the Fed is bringing inflation lower. So this side process of bringing the size of the balance sheet lower, in some sense, is a complication, because the goal is to use policy rate hikes as the main instrument to control inflation, but at the same time allow that quantitative tightening process to run somewhat in the background, as we often hear from FOMC policymakers.
Okay, well, let's focus on hikes and the rate of Fed funds. We just had a headline crossing the terminal that Raphael Bostic, the Atlanta Fed president, says more strong data could tip the Fed to 75 basis points in September. And Ryan, we pay so much attention to the size of each individual hike, but it's ultimately what they all add up to and culminate at, what that terminal rate is. What do you expect it will be? And once the Fed reaches it, how long are they going to have to stay there?
Well, that's right. Our thinking is that the Fed will reach 3.75% to 4% by February of next year, and that's pretty consistent with, you know, the collection of FOMC policymakers that we've heard from in recent weeks. And that really is what matters. That's not too far from what the Fed has been signaling over the last 2 months in its June dot plot, for example. And the key is, because of those uncertainties in terms of how long it will take to resolve this imbalance in the economy, it does mean that the Fed is more likely to keep that policy rate high for a long period of time. So we think at least through the remainder of 2023, we'll be talking about a steady Fed funds rate rather than a declining one.
So essentially what you're saying is the market is ahead of its skis and expecting that the Fed's going to be cutting next year.
I don't think we're about to get a big change in the Fed's messaging. All along, the idea has been somewhat of front-loaded rate hikes, moving from the emergency near zero levels that we were at the beginning of the year up towards a restrictive level. And restrictive in our mind, it means at least close to that 4% mark for federal funds. Now, at the same time, it's been a nuanced message. It's not been the case that these 75 basis point rate hikes that we've been getting over the two previous meetings in June and July, they're not set to continue forever. And so this raises this question, will September be that pivot point? Not in terms of pivoting to rate cuts, but pivoting to a slower pace of rate increase. That's a very close call. We are forecasting a 50 basis point rate hike in September. And so this is the careful messaging about slowing that pace of rate increase as we approach a level that's restrictive, but that the Fed will be sitting at to wait for inflation to come lower.
So Ryan, so you expect these high rates to persist through 2023. To Kaylee's point, though, does that mean that the Fed, Jerome Powell, are they motivated to try to reset market expectations about next year at all? Because that might dictate whether we get solid news from Jackson Hole or just something that the Fed wants to keep under the radar.
I think most likely there's not going to be a big reset of views in terms of the September policy decision. It's probably more likely than not that we won't hear specific guidance about that very close decision between 50 basis points and 75 basis points. Of course, there's always some possibility that Fed Chair Powell could just clarify things a little bit, and because we're getting even closer to that meeting, just solidify expectations more quickly. But the broader message is that we don't know how quickly we can, for example, see a reduction in the record high level of job vacancies in the labor market. In the last 2 months, we have seen a decline of about 1 million job postings, but it's coming from an extraordinarily high level. And so because we haven't ever seen that before in the historical economic record, it's very hard to make a judgment about how it's going to resolve going forward. And so that's why the Fed doesn't want to necessarily be locked into very specific guidance about how policy is going to proceed over the next 18 months.
The theme of this year at Jackson Hole, Ryan, is reassessing constraints on the economy and policy. Is this, do you think, reflecting how misunderstood or underexplored the supply side of the U.S. economy is?
I think that's certainly part of it. I mean, the emphasis on the supply side has been a byproduct of this surge in inflation that we've seen over the past 2 years. So coming into this year, there was an expectation that the economy would continue to grow rapidly, building on the over 5% growth in real GDP that we saw in 2021. As the year has progressed, we've learned that that's not the case. And a big part of that is the supply side of the economy. It's clear now in retrospect, with high inflation, with economic growth slowing, that the economy is closer to its productive capacity. And that sort of puts a cap on how quickly it can grow going forward. That's resulting in slower momentum for businesses and eventually, we think, slower momentum in the labor market as well.
Ryan, if we could tilt our eye in the more fiscal direction, we of course got the announcement from President Biden yesterday relating to student loan debt, that extension moratorium period until December 31st, $10,000 being forgiven. There has been a lot of debate on one side that that's just going to fuel the inflationary fire. Where do you come down on the economic impact?
Well, this is an interesting question as well. I mean, the first thing to say at the outset is, although the fiscal impact of the latest announcement, it is sizable. It's going to amount to several hundred billions of dollars. It is smaller, of course, compared to the very large pandemic relief packages, over $1 trillion in multiple occasions over the course of 2020 and 2021. Another thing that's important to think about is, there's a distinction between the budgetary impact and the cash flow impact of what we're hearing in terms of the extension of the moratorium on student loan payments and also some of that debt relief, right? Because we're really getting into the nitty-gritty where households in general do have high savings balances, but those balances are being slowly eaten away by high inflation. And so you have to think about not just what the latest announcement will mean for federal finances over the next 10 years, for example, but also break that down concretely into how much households will be saving over the time period we're concerned about, the next 12 to 18 months.
Ryan, thanks so much. Thanks for joining us. Ryan Wang, US economist at HSBC. Still to come on the program, travel disruption spreading around the world, a story we have covered many times, but now for a different angle. It is now inconveniencing even England's elite football clubs. That conversation coming up next. This is Bloomberg.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply? I mean, that has happened before.
We've looked at this very carefully, and the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry crossed $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta and Kaylee Lyons in New York. Now, England's elite football clubs wanting to travel to games by private plane are having to do something pretty unfamiliar, that is get in line. Rising demand for chartered air travel in the UK means many English Premier League clubs are seeing their plans for getting to and from away matches disrupted. Bloomberg's Sid Phillip joins us now with these revelations. Sid, I'm not sure how to feel about this story. I mean, it's disruptive for their pre-match build-up, I'm sure. But anyway, so soccer teams, football teams, as I would call them, here in the UK, here in England specifically, vulnerable to the same travel disruption as everybody else. What are the details?
Yeah, absolutely. So all the football teams are sort of facing issues that normal people have faced through this summer. And that's so much demand is basically making it really difficult to hire private jets. And that's largely down to the fact that during the pandemic, a lot of businesses moved to chartering planes, and they've continued doing that, as well as the fact that a lot of people are trying to escape the travel chaos at airports and other sort of airport aviation infrastructure, and they've moved to private jets. So you have football clubs like Chelsea, Leeds, Newcastle, all having to struggle and find planes. I mean, we had the manager of Chelsea say that preparation for the game that they lost against Leeds was massively impacted by the changes in travel arrangements. And Thomas Tuchel, the manager of Chelsea, had to take a bus to the game because there wasn't a plane big enough to fly the players and the trainers to the match.
Sid, put that into some broader context for us when it comes to the travel chaos in Europe that you just mentioned. I was actually just there a few weeks ago, and everyone told me, do not check in a bag, carry on only. Where is the most pain felt?
So the pain is still across the airports. I mean, we had Heathrow Airport earlier this month announcing that they were extending limits on capacity all the way to the end of October. There's been some good news. Gatwick Airport, London's second biggest airport, said that they're going to end the travel curbs that they have by the end of August. So there is sort of good news and bad news. I mean, British Airways, obviously the biggest airline at Heathrow, has also sort of extended flight cuts into the winter schedule. They've cut about 8% of their schedule going into winter. So it's sort of a mixed picture. It's been chaotic this summer, as we've sort of spoken about many, many times before. And I think that as the airline industry gets into sort of the winter months when typically travel tends to be slower, we might sort of see some respite.
Well, Sid, for our radio audience that don't have the benefit of pictures, I'm looking at all these images of fancy private jets with beds and couches. And just on the subject of flying private, it reminds me of the conversation we've had in years past when Davos is focused on climate change and yet everyone still takes their private plane there. Does your carbon footprint not matter if you're a footballer?
It does, and that's why expressing your sort of frustration with the disruption that affecting the private jet industry is sort of much harder, because obviously it is very, very hard to feel sympathetic for a football team not being able to charter planes, and also about the ESG footprint, and the clubs are being more conscious of that. And a couple of private jet operating companies and charterers are offering a club the ability to offset carbon as well as buy sustainable aviation fuel. But yes, it is a problem that the clubs don't really want to talk about, especially since a lot of fans may be offended by the environmental implications of it.
Yeah, I guess in some cases it might depend how far they're traveling, but yeah, valid point. Sid, thanks very much. Bloomberg's Sid Phillip with the latest on aviation and the way it's even affecting the beautiful game. Now, our special coverage of the Fed's annual symposium in Jackson Hole, in case you'd forgotten, starts. Our special coverage, that is, at 6 a.m. New York time. That's coming up in just 10 minutes. Tom, John and Lisa will be there hosting Bloomberg Surveillance on location live from Wyoming. I don't have it on any good authority how many of them will be wearing cowboy hats, but you never know. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after the game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg. However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Kriti Gupta in New York and Anna Edwards in London. Matt Miller is off today. Well, no one knows for sure what Fed Chair Jay Powell will say in his speech at Jackson Hole tomorrow, but one thing is clear. The potential for a market-wide shock is sky high. So why do economists and central bankers end up at Jackson Hole each year, housed not in fancy hotels, but rustic cabins? Bloomberg's Mike McKee sent this report from Wyoming.
It's gorgeous, but not luxurious. Jackson Lake Lodge is where economists and central bankers gather every year, not for the accommodations, but the conversations. Housed not in fancy hotels, but rustic cabins, they come for 2.5 days of eco-nerd talk about math-dense academic papers. They meet in this functional conference room, not quite the same as the electronically wired, mahogany-paneled Fed conference room back in Washington. For Global Wall Street, it's not about the conversations or the accommodations, but the implications. The papers don't matter much to investors, but the policymakers' comments on TV and in print do, particularly the Friday keynote by the Fed chairman. Talk of inflation, unemployment, recession, and what it all means for interest rates and profits. Now, we're here because of Paul Volcker. Back in 1981, the Kansas City Fed wanted a big name for their new conference. They came to Jackson Hole because the trout fishing is great, and Volcker loved to fish. The rest is history. The irony is this year, the financial world is wondering whether current Fed Chair Jay Powell will be Volcker-like in committing the central bank to fighting inflation above all else, even if it results in recession. If he isn't, stock markets might fall. And out here they know, you don't feed the bears. Michael McKee, Bloomberg, Jackson Hole, Wyoming.
I love a substantive report from Michael McKee that includes a cowboy hat, some antler chandeliers, and a mention of trout fishing, Kriti. But ultimately, it all comes down to, despite the images out of Jackson Hole, it's going to be the language from Chairman Powell, how hard he may push back on a market that is expecting them to pivot in the dovish direction at some point in time. Does he give us any real direction for the September meeting? Maybe, maybe not. But every single word he says tomorrow at 10 a.m. Eastern, they're going to pay attention to it.
Yeah, and that's really going to be the crux of it. At the end of the day, you heard it from Mike McKee, you don't feed the bears, except maybe in this instance you do. The idea that the Federal Reserve needs to really toughen up, needs to go hard on inflation, yes, that might tank the markets, but perhaps that is their gauge of success, Anna. And it's interesting to see that perhaps this is that moment where bad news actually does turn into good news, restoring some faith, some credibility into the U.S. Central Bank.
Yeah. Kriti, I was reading a really interesting piece by our Bloomberg colleagues about how markets have been moving in lockstep in the run-up to this particular Jackson Hole meeting, talking about cross-asset correlation almost doubling. Barclays saying that it's at the highest in 17 years. That's stocks, bonds, and commodities. That sets up some risk cross-asset, doesn't it, Kriti, around Jackson Hole?
It really does. From the stock market to the bond market, you can already see those jitters in the bond market. We're looking at 307 on the 10-year yield. I mean, on the surface, you're seeing 2-3 basis point moves, but to me, it's that intraday volatility, Anna, that matters. 10, 11 basis point moves when it comes to when the trading session starts to when it closes.
Okay, so we're prepared for the market moves. We're also prepared for the eco-nerd talk, as Mike McKee put it. You know, we tune in for that and we stay for the beautiful views, which if you're listening on radio, I know mean little, but we'll try our best to discourage conversations. This is Bloomberg.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and
and you're not a good company. You're just a less toxic company than some of the other oil majors.
Well, the first thing to say is that, you know, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view. And I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I think it's really reasonable to think that core inflation could surprise people to the downside.
You're seeing inflation expectations rise quite meaningfully across the globe.
That acceleration that we've seen in wages, you'll probably see that showing up in prices. So we could actually accelerate in some components of inflation.
What's very, very unique about this cycle is that recession risks and inflation risks are at odds with each other with respect to policy.
We're on the cusp, or we're in a global recession as we speak.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from Jackson Hole, Wyoming, for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. So scared of bears we came inside. That's not the truth. The weather's absolutely abysmal outside. The team's been rallying through the night to bring us inside and bring a show to you. TK, still a big day.
Inclement weather here in Wyoming for Chairman Powell. This is going to be really, really interesting, John. And what's interesting, I did an all-nighter, folks. There was such chaos here with the weather. I haven't had any sleep. And I noticed about 2 a.m., there was Chairman Powell rewriting the speech.
Would you like to talk about that all-nighter that you pulled last night?
No, but I think that's the tension. This is not a normal Jackson Hole, and they're rewriting the speeches right now.
It's not a normal Jackson Hole. And Lisa, I think we've all got to look back to 12 months ago when Chairman Powell delivered a speech right here and reread that speech, because I was rereading that speech in the last 24 hours, and I have to say, history hasn't been kind, Lisa, to that speech.
Transitory has failed. The idea of passing over inflation has not borne out in any way, shape, or form. How do they reshape that? How do they get ahead of that? Especially given the feeling that perhaps some of these inflationary aspects are stickier for a very protracted period of time. How do they reshape that?
The team putting together some great articles this morning and throughout the day, no doubt, here at Bloomberg. This from Marcus Ashworth, Tom, of Bloomberg Opinion. Jackson Hole should be a central bank mea culpa. A central bank mea culpa.
That's true, and Governor Bailey's going to show up to give his part of the mea culpa. I think it's 20/20 hindsight. It is valid this time around. There's some real questions there. I spoke last night to Jacob Frankel, the former governor of the Bank of Israel, and he was not scathing, as that's not the right word, but he's very cognizant that they have to reset here after a difficult 18 months.
We've got to reset and talk about the price action this morning, and here it is for you. We are positive about 0.5% on the S&P 500. In the bond market, I've got to say, the one thing that I looked at through the whole of yesterday was how close we came to 340 on a 2-year yield, Bramo. Backing away this morning by a couple of basis points, but what were we? 5-6 basis points away from the year's highs on a 2-year yield going into Chairman Powell tomorrow.
With greater inversion and this expectation for hawkishness, and really, how does he deliver on that? And if he doesn't deliver on that, do you see a rally in markets, especially as they pull together? More significantly, this is day one of the Jackson Hole meeting. We are not inside because of the bear threat, although I will say that when I got to the airport, it did say you can rent bear spray in a very big
Is this a change of
sign.
tune? Are we on the same page now?
You know, there were my taxi driver was speaking about mauling hikers, etc. We have an incredible roster of guests, including Seth Carpenter of Morgan Stanley. Esther George will be speaking with her own Michael McKee, and Megan Green joining us here. We're also going to be getting initial jobless claims at 8:30. This, to me, is going to be really interesting because it's all about the jobs market at this point. How much do they speak about what kind of pain, what kind of unemployment rate we have to see in order to achieve lower inflation? And today, Tom was skeptical to me that I was interested in Dollar Tree and some of the other retailers, but there are a bunch of retailers that are going to be reporting earnings, including Dollar Tree, Dollar General. Abercrombie & Fitch is not in the same category, but also facing some of the retail threats, as well as Ulta, Gap, Williams-Sonoma. The read on the consumer that we're getting from some of these retailers is fascinating at a moment where we're really seeing some demand destruction as a result of inflation.
Is this Fed speaking, John, to the people that shop at Dollar Tree? That's the heart of the matter.
I think that's a really important point. And when we catch up with Fed officials for the next 24 hours, I think that's a point we're going to bring up repeatedly. Let's start the coverage this morning. We can do that with Alan Ruskin, the Chief International Strategist at Deutsche Bank. And Alan, let's start right here. Chairman Powell tomorrow, what are you looking for?
Well, I think we shouldn't get ahead of ourselves. I think that's the starting point. I mean, he spoke about a month ago. I do think the Fed is going to push back on all this chatter about pivots. I think the notion of a hiking cycle that ends and turns into a rate cut cycle, by the second half of 2023. I think we've seen consistency from Fed officials that they don't really believe in that kind of cycle, that rates might well remain at some sort of plateau for quite some time. And in general, I think they are going to push back to thoughts of anything like a peak in the Fed funds below what we've already got priced in at around 3.75%.
Hal, on the day of the invasion of Ukraine, we spoke to your colleague David Folkerts-Landau, and he was heated about the tumult that will come, particularly on fiscal policy. The litmus paper of that is the dollar. This is what you're expert at. Have you and George Saravelis adjusted the Deutsche Bank dollar call with this dollar strength that we see?
I think what we've been doing, Tom, is really pushing out the thoughts in terms of dollar weakness and the broader idea that the dollar is not going to peak in a convincing way until there's greater resolution in terms of how Europe navigates its energy crisis through the winter. I think that's the first port of call. In general, the dollar strength you're seeing is in no small part related to problems elsewhere. It's in Europe. China's obviously slowing. Japan's got its problems in terms of very low interest rates and very easy monetary policy. So the dollar by default, I think, will remain strong, at least for the next few months.
Oh, I like that.
Alan, this goes to a point that you're writing a lot about that I find really compelling, which is the dollar as a safe haven and the potential squeeze inherent in that. And I take a look at not only interest rates, but also the fact that we could get a 2020-like move into the dollar. How risky is that at a time when the market is trading on macroeconomics more than possibly ever in its history, according to certain Barclays indicators?
Yeah, I think interesting, Lisa, that we've already had enormous flows into the dollar that relate to this sort of so-called flight to quality. I wouldn't get too hooked up on the word quality, but by default, the dollar has drawn in something to the tune of $1.4 trillion of short-term flows between the end of 2019 and Q1 of 2022. A staggering number. So a lot of the dollar's strength does relate to short-term flows, concerns about liquidity elsewhere, concerns about price action and risk elsewhere, and the dollar is the main beneficiary in this cycle. There are some other beneficiaries, of course. Switzerland has drawn in a huge number as well in terms of dollars in relation to GDP, so a big level of support for the Swissy as well, and the notable outflows have occurred from China.
So John and Tom were talking a lot yesterday, Alan, about how even if the ECB hikes rates substantially, it's not going to support the euro. What could potentially stave off the decline? How steep could the decline be in the euro versus the dollar if we see energy prices continuing to climb to new highs as they are today?
Yes, I think it's a short-term story and there's a long-term story. Over the longer term, if Europe and the ECB stick to hiking interest rates because they see through this energy crisis, then the euro in particular will benefit. I think you'll see the euro solidly above parity in 2023 under that kind of scenario if we get through the winter. I think it's a case of navigating the winter. And I wouldn't rule out, it's not our central forecast, but I certainly wouldn't rule out numbers like 0.95 on euro dollar if the crisis, the energy crisis, turns into rationing, for example, and real restrictions in terms of output. At the moment, we're thinking in terms of a slight recession, i.e., slight negative growth in the likes of Germany. But if that turns into something that's much worse than that, that's not what the market's pricing in at this point.
Hey, Alan, I've got to wrap it up and ask you about whether you expect some tension between central banks at some point, between the ECB, the Federal Reserve, between the Federal Reserve and the Bank of England. Clearly, euro-dollar and a break of parity is not what this ECB wants. Clearly, a break of 118 is not what this Bank of England wants. When do you expect there to be some real tension on the international stage?
Yeah, I don't think we're there. I think central banks generally believe in flexible exchange rates. They believe, I think, that the market is saying something in terms of trade shocks in particular that were being very sharply moving against the likes of the euro in particular, sterling to a degree, and has actually been helpful for the dollar. So I think you don't want to fight real forces like terms of trade. You don't want to fight monetary policy either, but I think the terms of trade elements are very much underestimated. So I think in this instance, the central banks are not going to push back in a big way.
Alan Ruskin of Deutsche Bank. Alan, great to catch up. TK, this is a big problem. It's got to be a problem already for the ECB, for the Bank of England, and other central banks too.
You can do the math. You can do the math on the terminal. Alan Ruskin is expert at this, and to his point, we are not anywhere near some form of drama like a Plaza Accord level. We made a joke yesterday about the Grizzly Accord. I think what you'd hear here is they don't need it. They don't.
Are we getting closer to that? Are we getting closer to that?
We are definitely moving in that direction, and that's a concern, and to be prepared for it. But those stresses just aren't there yet. Where are they on level? I'm going to guess, 0.90 euro.
Ramo, this is a problem already. I suggest it's a problem already for the ECB and the Bank of England that these weak currencies are not helping them at all.
Yeah, although what are they going to do about it? And this is the conundrum that I think a lot of people are facing, which is they're facing inflation they have not faced for 30 some odd years, 40 some odd years. In the face of that, what do they do? What does that accord look like? How do they project out what the inflationary trend is going to be over the longer term in an era of deglobalization and structurally potentially higher commodity costs?
Did you see the team at Capital Economics this morning?
Yes.
Capital Economics came out a little bit early this morning and essentially said the question is no longer whether Germany enters recession, but how deep it is. Lisa, that's where we're at in Europe. We know where we are in China. It's not pretty. I just wonder at what point we start thinking about this really hitting the United States. And what really struck me this week, and I think it struck you too, how quickly we were to just ignore the PMIs out of the United States, as if they don't matter, just wait for the ISM. Just ignore the PMIs.
Yeah, negative data at this point is being looked at as peripheral, even when it comes to home housing prices. If you take a look at housing activity, people are like, it's muddied, it doesn't really matter.
It doesn't matter. With Tom Keane and Lisa Abramovitz, I'm Jonathan Ferro.
I'm going to an open house in Jackson tomorrow.
From Jackson Hole, Wyoming. What are you doing there, drinking?
4.5 million.
There last night.
4.5 million for a shack. It's a starter.
Is there a party there you want to talk about? Live from Jackson Hole this morning. Good morning. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. There's more pressure on consumers in France and Germany today after power prices rose to record highs. They're now about 10 times higher than what they were a year ago. The astronomical rise is being driven by tighter gas supplies from Russia. That pushes up the price of the gas that fuels Europe's power stations. China has stepped up its attempts to stimulate the economy. It's adding $146 billion of spending, largely focused on infrastructure spending. That won't likely go far enough to counter the damage from repeated COVID lockdowns and a property market slump. President Biden's plan to forgive a portion of student loans held by tens of millions of people will ripple through the economy, but no factor will be more closely watched than inflation. Bloomberg Economics sees the potential to add as much as 0.2 of a percentage point to the inflation rate next year. That comes at a time when inflation is already at a 4-decade high. In Uvalde, Texas, the school board has fired the school police chief following that mass shooting in which 19 fourth graders and 2 teachers died. An investigation described Pete Arredondo as the commander responsible for police response. Law enforcement waited outside the school for more than an hour while the gunman was inside. And Swiss drug maker Novartis plans to spin it off its Sandoz unit. That would create the largest European generic and biosimilar drug company. The unit generated $9.7 billion last year. That is more than 18% of the parent company's sales. Novartis will now concentrate on developing breakthrough medicines. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy. I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions. A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
Yes, it's about renewables.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
On the David Rubenstein Show, peer-to-peer conversations
I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Today, as the world watches inflation rise, employment rebound, and fiscal policies react, all roads lead to Jackson Hole for the Kansas City Fed's 2022 Economic Policy Symposium. Bloomberg's all-star team is live as policymakers and financial insiders discuss the economic issues and solutions that keep the world's money moving. Coverage starts today on Bloomberg Television and Radio.
An entire generation is now saddled with unsustainable debt in exchange for an attempt, at least, at a college degree. The burden is so heavy that even if you graduate, you may not have access to the middle-class life that the college degree once provided.
The President of the United States, live from Jackson Hole, Wyoming. Good morning to you. Equity futures positive about 0.5% on the S&P 500, all gearing up for Chairman Powell to deliver a speech from here. 10 a.m. Eastern time tomorrow, so that is about 8 a.m. local time. Not today, Tom. Not today. It's about 4:20 local time here, so I've got to drop the volume just a little bit. Just make it a little bit calmer. Play that Jackson Hole soothing music that we've been playing through.
Well, what's great about that music, let's talk a little
and not wake up Chairman Powell.
Jack Fitzpatrick asked us, I want you to do some data here because we had some market moves in the afternoon, but this was the last of the Underwood projects. He's the guy. When you see Cary Grant in Northwest Passage and you've got a feeling of the American West, there was an architect who gave us that. This was his last project. It was built in 1955 under huge controversy, and the music that we use for our Jackson Hole broadcast is the original music that they used in 1955.
And we're still riding a horse and buggy. We're just, you can't see them right now. We're just still,
Okay, more on that a little bit later. I can't wait to play that music for you again. Futures up by about 0.5% this morning, TK. And you mentioned the moves yesterday. I think Lisa and I are on the same page here. Very much about the front end of the yield curve in America on Treasuries. Twos came really close to about 340. As you all know at home, the highs of the year about 345 intraday back on June 14th. So we're getting back to those levels, Tom. Getting back to those levels going into Chairman Powell later this week.
It is this arch anticipation, and what's fascinating to me is they release the headlines. He will give the speech. I talked to President George last night. YouTube, sort of zoomy, and then we will pick it up and have it on Bloomberg, I believe. And John, what are we anticipating?
Sort of zoomy.
Are we? Yeah. Well, yeah.
It's the zeitgeist.
No, it's just like it's modern technology. But the point is, John, is we have the headlines coming out and then the speech. And then what after that? And what's after that surprise is the data.
Well, the Kansas City Fed president dropped by our table yesterday evening, Tom, and said something else. It's also about the papers that get released. And I think we always forget that, don't we? It's made to be about the chairman this week, but there's other things happening here.
This year's different. I feel that very strongly. Let's do this. Let's go to Jack Fitzpatrick right now in Washington. And, of course, we're all looking at new legislation by the president. Everyone has an opinion. Jack Fitzpatrick, I thought Megan McArdle in the Washington Post today was absolutely spectacular about the two sides, the pitched battle, and as she said, what do the Democrats do for an encore? Jack, these things get embedded, and then what? What's the future of student loan forgiveness?
Yeah, that it raises significant questions about that. Megan McArdle's column argues that makes this a bad policy because it does nothing about the underlying trends of the cost of college and sets up the expectation of future actions for forgiveness. The Biden administration campaigned on this. I think they kind of entered this administration knowing they did not have a permanent or long-term solution to the cost of college. They could not do something like, people campaigned on free community college. A lot of the most ambitious proposals to get at the underlying issues were not politically feasible. So they're doing what they could do. Does it set themselves up for future expectations of similar actions? It very well could. I'm not sure President Biden is thinking so far into the future. He's asking himself what will happen next, what will future administrations do. This is very much a decision to make a short-term, near-term action that would affect a lot of people now.
Jack, our Jackson Hole dumb question of the week. How do you have a successful policy if the designer of EC10 at Harvard, Jason Furman, arch Democratic economist, is absolutely scathing? It doesn't rhyme. It doesn't make sense.
Jason Furman is somebody who I think is willing to disagree with the Biden administration a little more than you might guess based on his work with the Obama administration. He is speaking along with, maybe older Democrats who were more concerned than it seems President Biden is about the near-term deficit and the track we get on. This, I think, is an action that illustrates that this administration can rub Jason Furman the wrong way in some cases. I don't think the Biden administration is saying this is a perfect policy that makes sense for the absolute long term, but it's something they specifically campaigned on. People like Raphael Warnock in Georgia, who's up for a tough re-election, campaigned on it. And it's sort of a live another day kind of issue for the Biden administration.
But, Jack, it makes it really awkward for them. Let's just be honest, because we've been worried about inflation, people saying that is the #1 issue facing voters as they head to the polls. By almost all accounts, even Democratic institutions see this as mildly inflationary because people will be able to spend more money in their lives that they are not paying on student loans. How does he address this? How does he speak about the why now of this policy?
I think the why now makes a lot of sense from the Biden administration's perspective, in a political perspective. It may not make sense if you believed that reducing the deficit and addressing inflation in every way possible was Biden's absolute top goal. That clearly was a higher goal for someone like Joe Manchin, who made that a higher priority in the Inflation Reduction Act. I'm not sure that was the primary focus for the Biden administration. What they got out of that bill, as an example, that was potentially more of a climate bill to the Biden administration. It is a priority for them, obviously, to address inflation in ways that they can. But if you see, the numbers are 0.1 to 0.3% contributing to inflation, I think they see that as something they can accept if there are 40 million plus people who were very enthusiastic about this, and it's a campaign promise that they wanted to keep.
Hey, Jack, great to catch up with you, sir. Down in D.C., Jack Fitzpatrick there of Bloomberg Government. I think we all know the why now, Lisa, don't we? The why now? We're a few months away from the midterm. Okay. This is about the election, isn't it?
But it muddies the midterm election discussion. If you're worried about inflation, the why now goes against that. That said, a very big issue, something that needs to be addressed. The how is more the question.
We'll talk about the why now with Jason Furman himself tomorrow. Looking forward to that conversation. Coming up this hour, Seth Carpenter of Morgan Stanley. A lot still to come from Jackson Hole, Wyoming this morning. Good morning. This is Bloomberg.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
Live from Jackson Hole this morning, good morning. We'll be catching up with the good and the great over the next 24 hours. The good and the great that have had a difficult time calling this economy over the last 12 months. Your equity market going into that, futures shaping up as follows. Just about positive on the S&P 500, fading just a little bit though, up about 5 or 0.6%. Mike Wilson of Morgan Stanley yesterday, absolutely scathing about the idea of making a call of new highs on this equity market anytime soon. I'll bring you those comments a little bit later. I want to talk about the bond market as well. We've mentioned this a few times. Lisa's been talking about it through the week too. Yields at the front end just climbing back towards 340 in yesterday's session. We back away by a couple of basis points this morning, down to 337, down a couple of basis points into Chairman Powell's speech tomorrow. Looking at foreign exchange, this is how we started the program this morning. Euro dollar at about 99.85, a stronger euro today, but TK, this has got to be a problem for the ECB, a problem for the Bank of England, who are grappling with much, much higher inflation than they would like. And on the imported inflation side, certainly a weaker currency, a weaker euro, a weaker pound sterling, is not going to help them.
One of the great things here, John, that we've got on radio, I'm holding my iPhone. We've got the Bloomberg all squeezed into an iPhone, and John, it really works. And the data point, to your point, is yen. Yen hasn't moved, 136.54. Powell gives a different speech with yen at 138, and certainly 140 week yen is unimaginable.
The Bank of Japan hasn't moved either. Right, that's the big difference between, say, the BOJ, the ECB, and the BOE. Lisa, as you know, the BOE and the ECB, they're staring down really, really high inflation. I want to keep going back to this. Citi earlier this week. We should not let this go. No. Citi earlier this week coming out with a forecast for 18% CPI in the UK in January. That was just sort of a number we threw out there and we talked about a little bit, but can you imagine 18% inflation in the UK?
Well, this is what people are gaming out, and this is really on the heels of energy, and it's not just the UK. You're dealing with it in Europe as well. I just want to note that the euro valuation that you're talking about, the below parity is coming as traders price in the most hawkish moves ever from the ECB in the past few decades. This is a game changer in terms of the scenario for central banks where the potency is in question of their policy.
And not just that, the front end of the German yield curve, I think, has quadrupled in the last month or so, and yet, Tom, we've got a weaker currency. That's a problem. The prospect of higher interest rates, yet still a weaker currency.
Well, Lagarde missing from these meetings, but ECB represented in full force here, and they'll have comments, I'm sure, in the coming days. Right now, Seth Carpenter joins us, the chief global economist at Morgan Stanley, and what's so important about Dr. Carpenter is the historical perspective. Let us frame that at Jackson Hole, this began in August of '07. I have the fondest recollection of Stanley Fischer on the phone, urgent conversations 2 weeks after your world and our world blew up. Ben Bernanke rewrote his speech on August 31st, 15 years ago. It is not the responsibility of the Federal Reserve, nor would it be appropriate to protect lenders and investors from the consequences of their financial decisions. 15 years on, Seth Carpenter, it didn't work out. Balance sheet dynamics, original monetary policy. Explain to us how we finally extricate ourselves from a 15-year experiment that has gone wrong.
Yeah, I think that quotation from Ben is important. It sort of was supposed to have put paid to the idea that there's a Fed put. The problem in so many people in interpreting what happened, though, is the financial system is so fundamental to the U.S. economy that even if you're not trying to save investors from their decisions, if you're trying to save the economy, you end up intervening in a big way in markets. I think your question, though, about extricating the balance sheet, they are set at the beginning of next month to double the pace of the runoff of the balance sheet. The market knows that it's coming. I think the proof will be in the pudding, though, once that extra paper really starts to hit people's balance sheets, exactly how smoothly markets absorb the runoff.
Seth Carpenter, what happens to our viewers and listeners if we get a Mohamed El-Arian, I'm going to call it 4% level, or Anna Wong at Bloomberg Economics? How does that destabilize our financial system?
If the Fed takes the funds rate up to 4%, Tom?
Yes.
Well, I mean, first, I think we have to admit that that's clearly in the realm of possibility. The peak rate, I've been reminding our clients, where the Fed ends up with the funds rate is not sort of something they know ex ante. It's not a goal that they're shooting at beforehand. It's the result of how the economy is evolving as they tighten policy. I thought there was interesting comments from Raphael Bostic of the Atlanta Fed earlier today in the news that, they've got more data coming in. Those data could come in much stronger than they think, and those sort of determinations is going to help them decide 75 or 50 at the next meeting and ultimately where things end up. So how do we get to 4%? I think we end up at 4% if the economy actually is fundamentally stronger for the real side of the economy than we're forecasting right now.
Seth, you mentioned QT as well, and I think we've got to pick up on that. I caught up with your colleague Mike Wilson just yesterday. I want to share a quote of his from yesterday's appearance on this program. To be making some big call about new highs is, quite frankly, it's irresponsible given what's going on with the Fed and QT coming. Seth, it's remarkable to me, and I'd like to know what your conversations with clients sound like right now, but hardly anyone talks to us about QT, the impact on the market that it could have, and the impact, for that matter, on the economy as well. Seth, how are you thinking about that dynamic as it's set to ramp up and kick in through the next several months?
I mean, I think it's a critical part of the Fed's policy. Mike has been bearish for a while, and I think, the recent bear market rally that he's sort of not particularly enthusiastic about. Apart from that, the sell-off that we've seen earlier this year has been very consistent with this call. What is the Fed trying to do with higher interest rates, with the unwind of the balance sheet? They are trying to tighten financial conditions to slow the economy down, not just a little bit, slow it down so much that the inflationary pressures abate over time. That kind of slowing growth, slowing in spending in the economy can't possibly be good for earnings. And I think, our economic view and Mike's view on equities are very much aligned in that regard.
But Seth, there's a larger point here, which is how do we look at inflation and what the Fed is combating? And I say this because is it just about the strength of the economy, or is it about a fear that is growing among Fed officials, as per a Wall Street Journal article that came out yesterday, that this inflation is much more intractable than they previously thought, is rooted in a sort of reversal of the 90s globalization, as well as structurally higher commodity prices? How much are you really looking at that changing Fed policy over a longer term?
Key question, and I think you want to break inflation, at least conceptually, into three different parts. One is the part of inflation that the Fed really can't control by itself and could very well go away on its own. And there I'm talking about energy prices, food prices. We've seen oil prices peak and start to come off, so part of that inflation looks like it should take care of itself. Then there's the part of inflation that really is driven by strong underlying aggregate demand. So if you think about housing inflation, 40% of core CPI inflation is owner's equivalent rent and tenant's rent. That's really driven by this strong underlying underlying economy and the continued strong job gains, right? Over 500,000 jobs. And then the third component, though, is the mindset, the psychology, when economists call inflation expectations. And I think that last part is where, the Fed has a right to be worried. What happens if everyone just starts building at higher prices? So what's the solution? I think the Fed solution, and I happen to agree with it, is slow the economy down. It's growing faster than can possibly be sustained long term. 500,000 jobs per month just can't be sustained for that long. Slow it down, get realized inflation down, and then rely on the idea that slowing realized inflation, especially as energy prices come off, is going to prevent that psychological change to higher sustained inflation.
Hey, Seth, appreciate your time, as always. Seth Carpenter there of Morgan Stanley. His comments on the economy, very much in line with the comments we had from Mike Wilson on the equity market of Morgan Stanley just yesterday. And I want to reflect on what Bob Michael at JP Morgan Asset Management had to say on this market as well. And let's be clear about Bob through this year. He's not been a perma-bear. He's actually liked high yield when spreads gapped out wider to about 580 basis points. High yield spreads came all the way back in to somewhere close to 400 basis points. Guess what he thinks now? He thinks yesterday, this is what he said yesterday, he thinks we're rich, almost his words precisely, and he thinks looking out to next year, you can have a situation where high yield spreads gap out maybe to 650, pushing 700 basis points. Now, if Bob Michael's right, and you have a dynamic where high yield is back out at 650, 700 basis points, got to imagine where this equity market is, Lisa, with that going on.
Well, and this is the weakness in the economy that the Fed is trying to engineer that has not been priced in to not only the equity markets, but also the credit markets. When the credit markets start to get a whiff of it, is that the signal to the equities, hey, start getting a little more concerned?
I'm going to move my chair 1 inch away from these two. You guys are so gloomy. I'm here in the majesty of Wyoming. There are no empty seats on any airplanes north to south from Phoenix to Anchorage. The real estate price in Jackson Hole is comical the way it is. We have people driving us around that commute from Idaho, which I think is like a million miles away. I think the gloom is unfounded. It's a stated story. I get it. But there's an optimism out there that America can work through this versus other more static economies.
We're talking past each other, though, a little bit, just in terms of,
At 3 a.m., we're way talking past each other.
Okay, well, maybe that's an evergreen comment. But, there's a question about longer term making it work and shorter term, a pretty massive sea change in inflation and what the Fed's role has to be in combating it. And I think that's what we're talking about.
I'd go another step further. And Tom, I think you're on the same page. How many times have you talked about the two Americas? Our experience on a plane coming to Jackson Hole and landing at an airport with about 10 different private jets, 10 different private jets lined up, is very different to the experience of the stat that we read out yesterday on this program. 1 in 6 Americans are falling behind on their utility bills. Do you not think there's something going on here? I think we can't just make these broad-based assumptions about the strength of the overall consumer.
And critical in sort of recession, if that's what we're in, these people are crushed in the middle class of America. I'm sorry, Powell has to address that tomorrow.
Chairman Powell coming up tomorrow, live from Jackson Hole, Wyoming this morning. Good morning to you all with Lisa Ramitz and Tom Keene. I'm Jonathan Ferro.
I just saw Buffalo.
It's Bloomberg Surveillance.
Give your Buffalo
There's
spray.
like 20 bison out there.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The Biden administration has won a judge's order ensuring women in Idaho can get abortions in medical emergencies. That came less than a day after the administration lost a similar fight in Texas. The mixed outcomes point to a hotly contested court battles ahead. In the UK, 2 research groups say the government will have to draw up previously unthinkable measures on the energy crisis. The Resolution Foundation and the British Chambers of Commerce are calling for COVID-style emergency support to deal with soaring costs. Natural gas prices are now 10 times higher than the last decade's average. In Los Angeles, a jury has awarded the widow of basketball star Kobe Bryant $16 million in damages over photos taken at the scene of the helicopter crash that killed her husband. The spouse of another victim was awarded $15 million. The photos were taken by emergency personnel. Los Angeles taxpayers will foot the bill. More signs of weakness in the semiconductor industry. NVIDIA gave a disappointing forecast for the current period. That comes 2 weeks after the company warned that sales for the latest quarter would come in well below original expectations. And Bed Bath & Beyond is closing in on a lifeline from Sixth Street Partners. Bloomberg's learned their home goods retailer is in talks for a new line of credit that may be around $375 million. That will give Bed Bath & Beyond breathing room while sales slump and it burns through cash. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China. But African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window. They have thorns on them.
No one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming true?
There was something of a grey zone battle between Taiwan and China.
Where are the job cuts to come from?
We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply? I mean, that has happened before.
We've looked at this very carefully. And, the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry crossed $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. And it's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
Our view is that the Fed basically stops by the end of the year. I mean, you're going to be at 350 and the hiking cycle is going to be done. But the real risk is that the Fed does not unhitch its wagon from inflation, particularly headline prices, and that they just keep on going.
That was Tom Porcelli of RBC Capital Markets just yesterday. If you're just tuning in on TV and radio, there is a reason we are indoors and it is not grizzly bears. The weather's appalling outside, so the team's done a fantastic job overnight. That is the truth. Don't start rumours and conspiracy theories.
Carry on.
The team spent the last several hours putting together a little mini studio inside the lodge. So it means that we can be very critical of the Federal Reserve now, but at some point in the next hour, Chairman Powell's going to wake up and walk past and
that will be really laudatory.
maybe we'll be super supportive of that speech he did 12 months ago, because, Tom, how could he have possibly known that inflation would not be temporary and so-called transitory?
Well, we're going to see on that, and that's certainly the arch theme here, is to look back, but I think the look forward is just as important. What I would note in coming to Jackson Hole is you see front and center elements of the drought that is across this nation. John, some of when we came
you
came
mentioned
up,
that, yeah.
The water level was way lower. The lack of snow, I've never seen 2 years in a row here with a real lack of snow.
The future's right now positive about 0.5% on the S&P 500.